Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day to day so we can design a business that gives us a life of independence. What's up? Welcome back, and thanks for tuning back in. Today's episode is a must listen for anybody who has looked at their financials and thought, what the hell am I supposed to do with these and how do I make decisions off of them? Today, I'm bringing back Tracy Bech, who is the creator of the 60-Minute CFO. And trust me, this conversation will change how you look at your numbers and therefore your business forever. Because understanding your financials is not just about looking at top line revenue or even net income on the P&L. It's about creating clarity that ties every single decision you make in operations back to your ownership goals of time, cash flow, and wealth. Tracy and I break down the 14 ownership KPIs that she's identified and rolled into her 3-statement model that you need to track in order to predict your free cash flow, understand your future valuation, and how all of your operational decisions are going to impact where you want to go as a business owner. I know this podcast episode is a little bit longer than most, but it's absolutely worth your time because we don't just talk about the metrics. We dive exactly into how these KPIs show up onto the 3 statements and then how they show up in the real world and how operational decisions and operations create these 14 KPIs. And even more specifically, what do you do about them once you understand them? So whether you're scaling a service-based business, dealing with inventory headaches, or just trying to figure out what it's going to take to fund your lifestyle or hire a executive and hit your ownership goals, this episode is packed with insights that you can immediately apply. You might want to listen to this once or twice, or at least take a pen and paper and make sure you're jotting down some notes. And if you've ever felt like the financials were a big black box or it was a source of your biggest anxiety, this episode is going to be super enlightening. So I hope you enjoy this conversation with Tracy. Well, I'm excited. Tracy, good to have you here again. I know I was actually told you that you were the top downloaded episode from 2024. So that's the Spotify recap. So congrats. And I think it's the title, or maybe you're just that awesome.
I'll take it either way. I joked with you that you were telling everybody that you were ginning that up in AI and telling everybody they were their top downloaded episode.
Yeah, that's a good idea. Yeah. Everyone's awesome.
If I can rank high among your audience, that's about the highest praise I can get. So thank you for that.
There is no participation awards here. So it's legit.
I'll take it.
So what we were just talking about is I'll put a container around the conversation for the audience and they can kind of follow our journey, understanding the financials and how the financials can get us the information that we need. And just to kind of reset us, is when I met you and I was talking about what I had learned from Pat Hobby was the 3-statement model, mathematically tying them together, pushing those into the future is what gives us the information. And so it's not always about the financials at all, because people go, well, it's only you're only talking about the financials. Like, no, this is about decision making. And what has really been fun about working with you is taking the infrastructure that you have built with 60-Minute CFO and your template. So that way it's not custom people. It's really accessible from the training, the template. And you've been doing a lot of additional enhancements with the out year forecast, the value gap tab. But like, when I met you and I said, hey, Tracy, what my clients that are owner operators care about is what is their free cash flow in the future? Like, hey, if I need to make 500 grand in free cash flow after my working capital, after my taxes, and after my reinvestment, can I maintain my cash flow and maintain that growth? But there was no decision-making process for people because they don't have this mathematically tied together model that Pat Hobby gave me the visibility of. But it was like, we've talked a lot about the complications of custom making that every single time is very difficult. People's data is very difficult because it's not clean. You've solved that problem, I think. And what we want to do in this conversation is talk about what information do we want and what decision-making does that give us if we have the right material. But then I think what we should also do is, what is the logic of all this stuff tied together? Because like, if we don't understand how it ties together, we don't know what to read when we're looking at it. So I don't know where the liftoff is there, but maybe talk, any thoughts about the ownership stuff that I'm doing and what you built and how this kind of syncs together before we jump into like what it is that we need to be looking at?
Yeah. I mean, I always think of the way you and I work together is that if we were college courses, mine would be a prerequisite for yours. Right. So you come in and maybe you already know a lot of this stuff, in college, you take like a lot of stuff and you're like, all right, I know this, but they make you go through the 101 classes so that you can get to the upper level stuff, which is I think where you come in, Ryan, and you really bring a lot of meaning, even more meaning than I think what we think of as 60-minute CFO's meaning, to it, because it starts to really give more weight to the forecasting piece that we do at
Why it's
60-minute
important.
CFO. Yeah, and 60-minute CFO has 3-part process, right? And the overarching piece of all of it is that we believe in keeping it simple, because this is already daunting and really, let's be honest, probably hardly anyone's favorite topic in school, right? Like if these are
None
prereqs.
of the people that were on the group call with us were CFOs. It's like commercial cleaning or electrical contractor or HVAC or you name the services. And it's like, oh, now I have to like figure out these financials to get the decisions that I want.
Yeah. And I'm right there with them. Like, you guys know my past, right? Like that was not my cup of tea. It was not why I got into this game of business. It was really not for the finances. The issue is that you can only get so far with that intuitive knowledge of it and trusting other people to do it for you. It's not that people aren't trustworthy, but you know, it's really only you who's going to care the most about your business, right?
And
So
understand the intricacies, right? And like, before we keep going, I think what's back to the entry level course and advanced. I think what's also interesting, and I think the advance is the advanced decision making that comes once all this is done. But like, what I find very fascinating, Tracy, is that my workshop and the conversations that I have a lot of the simplicity of the ownership stuff makes people want to do this really not fun work. So it's like, it's even though it's technically the advanced when they're executing it, it's like, hey, at the end of the day, as an owner of a company, I need to do things with my operations to generate free cash flow for me after I fund the company in working capital, reinvest the growth, and pay my taxes. So like that like level of simplicity of why this matters, and like when I think which gives people the desire to go into your material, because like I was sitting down after this workshop I did, and he's building a $20 million manufacturing plant. So he's adding on. He didn't buy a company. He's building a $20 million manufacturing plant. And I looked at him. I said, "That's awesome." I said, "Do you have any idea what your free cash flow will be in 24 months once this thing's up and running, after you have working capital that's not different, taxes, reinvestment?" And he goes, "No." I'm like, "Doesn't that scare the shit out of you?" And like, it's just that like complete awareness of like, I don't have that information, even though like that's at the root of it. I just need to, what's the trade-offs of reinvesting, paying my taxes, and like that quick, easy decision tree most people don't have. And maybe we talk about why they don't have that information. And that kind of ties into the 3 statements and how they're tied together. But like, isn't that like at the root of it? It's like, if you don't know that, you need to go into Tracy's material to figure out how all this stuff works.
there's so much that I think you could unpack there, because it's a mindset shift. I mean, I think that entrepreneurs by definition are risk takers, and we are more risk tolerant than the average population, period. I think there's also work that talks about how driven we are, right? And it's just like a gene. There's something in us, like we're chemically wired to go out there and take risks and go, 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 go. And it gets us really, really far, especially if you get over year 5 or 10 in business. You've really outperformed the majority of businesses, right? So then you just kind of keep going on the fuel that got you there until that fuel starts to run dry a little bit. And I
What
think
do you mean
that's
by
what
define
the
fuel in that?
fuel
Yeah.
in my
Yeah.
mind is your intuitive knowledge and your gut knowledge, and the way those two things work together. And you know just to when to roll the dice. Like, you know when to hold them and you know when to fold them in business, right? And so you get to a certain point, and it's funny. I hear entrepreneurs talk about stuff, and it's always so curious to me, because they're seeking the knowledge, and so they grab onto things that they have. Like, I'll get asked, how much is the right amount of money to have in my business bank account? I'm like, well, I can't answer that question for you. That's a context based question. Like, I don't know. There's no one size fits all right amount of money to have in your bank account balance, but they are thinking in those terms. Well, I know there's probably like a right amount of money to have in the bank account. I'm like, well, even if there was, it wouldn't be static. And
It would have context. And let me add to that, because one of our mutual friends, the guinea pig, we were talking about working capital, and people have probably heard me beat that drum recently a lot, because You have your payables, receivables, and inventory, which is not your money, right? So you have cash tied up. And what happens is this gentleman and a lot of people, back to this fuel, the intuitiveness, is I normally have $1 million in my checking account. Receivables are normally $4 million. And it's like, well, if you double your company, what would those be? Well, they would obviously grow. And then what flipped for him in our conversation, like they're gonna grow and we need to see that. But as a percentage of revenue, it should have a certain correlation. So, but like your gut can't get you, because like if it's like this homeostasis of like, I love the $1 million in my checking account. Well, it's like based
Why
on what
and
growth rate
what?
and why, right?
Yeah, and what you hit on is exactly right. It's always a relationship to something else. So yeah, $1 million as a percentage of $10 million in revenue. Maybe that's the right number, but we have to know what revenue is. Maybe it's $1 million because it's 3 times our monthly expenses. But those, not all revenue is created equal and not all expenses are created equal. And not all expenses behave the same way in your business.
Especially within a journey from point A to point B. If you're going to go from 20 million to 40 million over 6 years, it's like all of that will change along the way.
Yes. And we know that. And I want to just give everybody a lot of credit here because everybody knows what I'm saying to be true.
Mm-hmm.
They just
Mm-hmm.
haven't heard me say it as truth, right? If they haven't gone through the training yet and they haven't had somebody just sit down and explain it to them, then they know it but they can't put their finger on it, right?
Mm-hmm.
And a lot of what we do at 60-minute CFO is letting you put your finger on it and go, this is how my business is working and I know it intuitively, but now I see it objectively. Like I can point at
Objectively,
it.
and in the context of the whole
Yes.
picture and the roadmap,
Yes.
right?
And now I know. So, it's kind of like you know how to drive a car, but if it breaks down and you open the hood, you also still kind of know vaguely where the battery is and the
I was
radiator
gonna say I don't know
is.
what to do. It's
Yeah.
either I
But
need
then
gas or oil or
yeah, and
quiet.
so you're like, okay, well now if it's not gas or oil, what do we do? And that's where we usually just trust, a mechanic to come in. But 60-minute CFO takes you a little bit further under the hood and is like, look, the 3 statement model is what's under the hood of your business, and here is exactly how it's working. So if you want your car to go faster, we would tweak this like this. If you want your car to go further and get better mileage, we would tweak it like this.
Mm-hmm.
And
Mm-hmm.
and it's just adding a little bit. You don't have to. I'm not asking you to open, your own car mechanic shop and fix everyone's car into the sun. I'm asking you to become a little more familiar with your own car so that you can get it to do what you want it to do. Now that you've
Right.
drank Ryan's Kool-Aid, we need you to be able to understand how it's not just to sit back and relax. I mean, it doesn't have to be torture, but we got to understand what are the drivers here?
Yep.
Like, how are
Yep.
we going to make this
Before, yep. And that's exactly what we're going to get into. But to double click on that just a little bit more is the only thing that matters is free cash flow. So like when we look at like why would we open up the hood, and it's like, but the goal is to generate more free cash flow and more sustainable free cash flow. And the only way we can see that is to mathematically tie them together and then put them from point A to point. So if you want to go from 2025 to 2030, we don't have any ability to get the context of you open up the hood, where should we look? If we don't know what the goal is free cash flow. And we have to have the start and the end to mathematically have all of that inner relationship. So then and back to your point of like, no one wants to be financial engineers. I don't. And the only reason I ended up doing this is because I personally needed to know where to look and what it meant. So I knew what to do and how to delegate it. And that's what we're trying to do here is like, when you look at something, you can go, oh, working capital is higher than it should be, which is going to impact my free cash flow. Or like margins are eroding and it's going to impact my free cash flow. Like, and so it's the context of the relationship to the goal, which is free cash flow, and interpreting it. Because otherwise, and I think, Tracy, this is where a big issue is that in private equity, and I've had some interesting stories this last week of people calling in total disasters. PE firms know the financials, but they don't know how all those numbers get generated because in the operations. But the people listening in, I think you and I have this shared belief that teaching this, what we're about to talk about, is easier to explain it to an owner operator who knows how all this works than to teach a financial engineer how the operations work and what's real. Because at the end of the day, we're trying to predict the future, and they make these absurd assumptions because they don't know the reality of operations.
And PE will say, it's a mindset shift. You just have to think bigger. You have to do this. And they tell the owner operators this about their own business. And then, the owner operators are like, oh, that's great. Yeah, you're right. I'm just not thinking big enough. Except for that the owner operators are the master of the craft, right? Like, what you are doing in your business.
And the craft
Better
is
than
the
anyone else.
operations and the
Yep.
ability to grow. Yep.
Yes.
Yep.
Now, I like to say though too, I like to remind them that and let me just trust me that what I'm trying to teach you in terms of financial engineering is far simpler than what you already understand as being an owner operator of your
Amen.
business.
Amen. Amen.
Yes.
And so before as we continue to lean into your methodology of explaining this, I'll start with one of the big shortfalls I see in the market and then where you fit in. So like the benefit that Pat Ivy gave me is like it's the gold standards. Like, and it's like, okay, if this is how the financial projections work, where you're tying the three statements together and you have the projections, you either have this or you don't. It's math and it's a spreadsheet. This is not Ryan's opinion or Tracy's opinion. And so now, Tracy, what I end up doing, and like, is because I was so convinced and so convicted that this has to be done so we can get the information. Every time now I go, okay, well, someone will say, well, I've got a director of finance or a CFO or controller. It's like, okay, great. Do you have a three-statement model where your income statement is mathematically tied to your balance sheet, is mathematically tied to your cash flow statement every month, and then all the way to your 5-year goal? Because what happens is if we have a client that says, okay, I want to take, let's say I've got a product out of $10 million, I got $5 million in product and $5 million in services, and I want to sell $8 million in service and $4 million in product in 4 years. How will that ripple from my income statement or from my revenue to my cost of goods to the overhead? Because all of that impacts cash, but we can't have just an income statement into the future because then we don't know the free cash flow. And so where I'm at now, Tracy, when I look at my clients or the owner operators or people in the audience, I'm like, they're like, well, I've got a CFO. I'm like, do you have this? And they're like, no. And I'm like, well, then your CFO or your professional services firm is not doing their job.
I am not going to bash the accounting industry by any means, but hairdressers have more certifications than CFOs. There's no licensing program. There's no gold standard. There's nothing that says this is the way you do CFOing, right?
Right.
There's
Well,
nothing.
and I want to add to that. Amen. But also, and I'll put the link into the show notes. Pat Hobby and I did an episode years ago about the difference between a CFO, a controller, a banker, a bookkeeper, and a CPA. CPAs are, and so when I was interviewing CFOs, for some context here, Tracy, the first question I'd ask is, do you have an accounting background or finance background? Because the accounting background is debits and credits and understanding how the GL codes all should be bucketed so they can close the books. But that has nothing to do with the mathematical operational projections. And so sometimes an accountant can move into, like Pat moved into finance, of like being able to project out the operations because he needed to, but CPAs move numbers into boxes, close the books, and file tax returns. That is, and they have a lot of certifications
And
for
they
that.
have certifications, yes,
For just
sure.
that's why I wanted to bring this
For that,
for
yes.
that, not
Yes.
for projecting out the three statements where you need to have the mathematical financial equations to tie all this stuff together.
Add to that the ability to explain it to the owner operator. No,
Sorry, I laughed because
it just doesn't happen. No, I mean, you
right.
ask a question and you get an answer. It makes less sense than what you thought you knew, right? You're just like, can you explain it to me like I'm 5? How can I, and it's so disheartening, right? It's literally two different languages that we are
Yeah, because the
speaking.
CPA says you did great this year. Net income looks great. And you're like, I have no cash for taxes or distributions.
Which is the title of our last episode. Yeah. So, story of my
Where's
life.
the money?
Yeah. Where is the money? And how is it that I'm doing great? Yeah, sure. I showed $1 million of revenue on my tax return, but it doesn't feel great. It doesn't feel great. So we have to become our own engineers, right? We don't need to understand the whole engine. We just don't need to understand the whole engine. But the three-statement model is key. And the coolest thing about it is that it really can be simple. Right? Like once we just accept that this is the way it works, and then we know that this is actually all of it, right? Like it doesn't go past this. And the coolest thing is that the income statement and the balance sheet you can pull all day long out of QuickBooks or whatever reporting software. The cash flow statement is just derived from those two things, right? So the third one is derived. And so
Well,
we,
let's talk about how that is, because like when I learned that these about 6 years ago or something, the cash flow statement is just the mathematical difference between the balance sheet over 2 periods of time. The cash go up or down, the receivables go up or down, inventory go up or down, and I was like, oh my god. And it's like, so like, and maybe you can start with how the income statement and the balance sheet interplay together, because if the cash flow statement is an output of two balance sheets over a period of time, which then gives us our cash position, but like, because so many people are familiar with the income statement, but it's like the way I think about it, it's like looking at the world in 2-dimensional when we need to look at it in 3-dimensional.
yeah, and it's a common trap. I mean, this is just the most common thing because the income statement tells us the vanity metrics, the stuff we love chasing and that we love to toss around in our, like business groups and with other entrepreneurs. Like we love to tell people what our revenue is and how much it increased and what our profits are and how much they've increased, right? But uh that doesn't tell the whole story, right? That's just on the income statement. And what doesn't hit the income statement happens over on the balance sheet. And we touched on this a little bit in our last episode, but and then the two combined go into cash flow. So on the balance sheet, we're measuring what happened to our assets, our liabilities, and then our equity, which is really just assets minus liabilities. The balance sheet balances our assets have to equal our liabilities plus our equity. That's how it balances. So it's this interesting little math formula over here where it's actually, it like goes back apparently to like ancient Rome, the way
The
they
14,
figured this out.
actually, Pat always said
You know this one.
the monks in the 1400s created double entry accounting.
Yeah. Yeah. And the balance sheet kind of hinges on all of that. So not to make anyone more confused than they need to be, like, let's not even talk about double
But
entry
before
accounting.
we keep going, because like this will then tie into the cash flow statement, like what, because I in what actually one of a couple of comments is when I was interviewing ITR economics recently, Brian Billio was like, how many of your clients start with the balance sheet and clean that up? And it's like, yeah, exactly. Your face, exactly. But like that generates the cash flow statement, and
Yes.
so what ends up, but what I think is to not get lost into, and actually Ken Sangenario was just I was talking to him recently. He's like, so much of that can become financial trickery,
Oh,
because
yes. Yeah.
free cash flow is the only thing that matters, and the thing that can get lost in the balance sheet is goodwill, IP, all this bullshit that people are. When I say bullshit, it's like because someone's identifying what are assets and what are liabilities, but what is not bullshit is receivables, inventory, and payables.
Yes.
That's why they call it working capital, because those things are not subjective. That
Yes.
is the nucleus of the machine that has to keep going. But the other assets and liabilities, and I don't know if you want to expand on this,
Yeah.
but like they can be manipulated.
Oh, yeah. Well, because equity is the difference between assets and liabilities. So if you want to throw goodwill in there, the way you make it all balance out is that actually ends up in your equity, right? The equity like adds up so that it's counterbalancing the asset that you just kind of made up and put on the balance sheet, right? So there are a lot of balance sheet adjustments that you can do when you're really looking at like what is actually happening in your company, which it's, I think, smart to do to take things like that off. The other thing that comes and hits the balance sheet and the income statement is depreciation of assets, right? Which is something that we do. And it like we end up really doing it to kind of account for the cost of that asset over time, but also for tax reasons. You can do it fast, you can do it slow. There's all these things that it's kind of like at the end of the day, to your point, what's the free cash flow doing?
Right. Yeah. Great. I had $500,000 of depreciation. I got some goodwill on there. It's like, what's my cash?
What's the cash?
What's the
So,
cash?
yes. So let's just talk about what hits the balance sheet and why we should care. We'll start there. And, again, because we keep it simple at 60 Minute CFO. So just simply put, when you buy inventory, that's not an expense on the income statement, right? That does not come out of your income statement. It shows until you sell that inventory as an asset on your balance sheet. So that was that story that I gave, is like we had so much inventory and no cash, and we didn't realize that the cash was in the inventory, that
Because,
we
and let's just talk about operation and what happens. Well, you and I have an e-commerce business, or like, I mean, back when my copier business, I go buy $1.5 million worth of copiers. They sit in my warehouse, and well, no, it wasn't copiers; it would be more the consumables. Because like I go buy couple $1 million worth of consumables, and they just sit there. Like they have to be recognized against a contract or a revenue
Yes.
to go from the balance sheet into cost of goods to revenue, right? I mean,
Yes.
like it's,
Yeah.
but we use cash to buy it
Yes.
first.
Yes. And you use cash to buy the inventory. And when you use cash to buy any asset, like anything, right? Like whether it's something like a current asset like inventory, which you're probably going to convert to cash pretty soon, or it's an
Hopefully.
asset like a fixed, right? Hopefully, not guaranteed. But or it's a fixed asset like you had to buy, a car or a truck or some desks or furniture or whatever else you need to run your business, right? Forklifts, whatever, who knows?
Or even like let's go like property and casualty insurance. I mean, like you're using cash to buy things every month.
Yes. Yes. So that if you're buying an asset, cash went down and assets went up, and that happened on the balance sheet. And until you sell that inventory, you don't recognize it on the income statement, right? So once it's sold, then you can recognize the cost of the inventory on the income statement as one of your costs, and the revenue that you got from selling it as part of your revenue. So now you have more revenue. You got to take some, you finally expensed, quote unquote, that inventory, and then your net profits, right, come out at the end. So when we do that, anytime we bring on assets, cash goes down, but we don't see it at all on our income statement. So that's the first thing to know, is that you could have a really profitable month. You could have a ton of profit, right? It could be your best month ever, and you could have no cash because you turned around and bought. Maybe had to replenish inventory. Maybe you had to gear up, right, for your growth cycle that you're on. And that's the classic scenario of when people grow broke, right? They overinvest in
Well, and
inventory.
there's a couple things to that resonate with me that I've grabbed onto for concepts is like, so when I do my workshop, when I'm showing the interplay of these three statements, 'cause I do it my own way, is you start with a balance sheet because like you start your operations, right? You have contributed capital, and if you have partners, you have contributed capital, and it's either IP or cash or sweat. But like you start with the balance sheet, and then I say you do things that month, which is the income statement, and then it results in a second balance sheet. But because if you and I funded a company with $1 million, we would fund the stuff, the inventory and all that stuff. So that doesn't mean we have $1 million in cash the next month, because we use that stuff, that equity, to buy stuff, to do things, to generate something. That doesn't mean we have cash next
No,
month.
it's simply the source of the funds and how they were invested, right? Like is it from a shareholder contribution, or did we get it from debt, right? Or did it come from operations? Like, did we get it? Was it from cash? And then how did we use it? Like, is it in inventory? Is it in payables? Is it
Mm-hmm.
in accounts
Receivables.
receivables?
Yep.
Yeah. So what's going on with it? Um, so we break so okay. So the balance sheet, when we invest in assets, cash goes down, right? So when we see two balance sheets, okay, like we have balance sheet on day 1 and balance sheet on day 30, and we see assets go up, we can just intuitively know, like once we start to understand how these things are tied together, that cash went down, right? From that activity. It didn't maybe go below last month, but it went down. Like we had to use cash to buy those assets. So we know that that happens. Then correlatingly so, let's talk about liabilities, right? So liabilities come in, and we can have when the liabilities come in, it's stuff that we owe, right? So it could be short term, we owe it in the near term. So it's like our payables, like the software and the short term, like our payroll, all of these things that we owe on a regular basis. And then there's those long term loans that we are paying down over time. And for both of these things, when liabilities go up, cash goes up. So because which sounds wrong, right? Because I said when assets go up, cash goes down. But when liabilities go up, cash goes up. Because if you think about it, just in terms of like the most classic liability ever is like a bank loan, right? The bank gives you money. You now have a bigger liability. The bank gave you money, liabilities went up, so did cash. because that was what you borrowed, right? So we have to recognize these things are affecting our cash, but none of that revenue, you didn't earn the revenue, so it didn't go into your revenue bucket on your income statement. You didn't like bill the
None
bank
of
for
this has
that.
anything to do with sales, cost of goods, or
No,
overhead.
no. So all of these things are affecting your bank account. Meanwhile, you're over here either having a great profit or a great revenue or whatever. All that's happening on your income statement. And the balance sheet and the income statement both have really important information on them, but most business owners only look at the income statement. And they really then further only look at the top line and the bottom line. And only
Right.
do they look
Right.
at other lines if there's a problem. Right.
Let's talk about a couple other operational scenarios that I know I've seen in my past that result in this ambiguity and lack of awareness of the cash. So like I've had, whether it's commercial construction, residential construction, or I had like sign manufacturers where you do percentage completion of recognizing revenue and cost. But like, let's say I go in and you get a customer deposit for 50% of the project. And then you're like, let's say that project let's say it's $100,000 project and takes 4 months. And let's say you randomly actually did 25% of that project for 4 months. You would have 25% of the revenue as the percent completion, and you would be recognizing those costs in proportion to those revenues. But you might have bought all your shit at up front. So you use all your cash and you get but they only give you 50% of it. And so you're not getting your full margin for 4 months. And so there's all these operational issues in the operations that impact your cash that doesn't reflect the income statement.
Exactly. And that's one of the biggest pitfalls when we go to grow and we aren't thinking about actual timing of cash. Timing of cash makes a big deal, right? Like it's a big difference if we get it all up front or we get it all at the end. And one of the common things, not true across the board, but very common, is that the bigger the project, the slower you get paid. Right. And you have to fight. And also the larger the company, the slower you get paid that you're interacting with. So you have to fight for the right to party. No, just kidding. You have to fight.
Hell yeah.
It's like I have to fight for the right payment terms, right? Like you gotta align your receivables with your payables. And if you're not thinking about how your engine runs, how these two models work together, and you're just thinking, oh, we're going to get paid so much for this, and we didn't realize whoa, the timing of this though, it's going to matter. That's more of like less of an engineering, more of a timing issue. Yeah.
Yeah. And I'd say you can engineer the outcome you want if you know this stuff. So one of the ITR economic podcasts I did with Brian as well is kind of stuff went sideways over the last couple of years with supply chains and inflation. He goes, the real sophisticated businesses are doing balance sheet battles. And I was like, oh, that is such a great statement, because it's like, well, if I have receivables with you, you have my money, right? If I'm paying my payables really fast, you have my money.
Yeah.
So and then the inventory. So it's all these people that the financial engineers of businesses, they're maintaining their hyper focus on cash, and their supply chain and their customers, they're constantly battling other people's balance sheets for that money all the time.
Yeah. Well, I talk about this like when I see customers or clients of mine who have really high accounts receivable, I always ask, how many of you are banks? Like, how many of you are business banks? And they're like, I'm not a bank. Yeah. They're like, we're not banks. And I was like, well, you are if you let your receivables go past their due date, right? You've just given them an interest-free loan from the bank of you, right? So, but then conversely, yes, like how many of you think that your vendors are banks, right? So if you're not paying your payables on time, yes, you have made your cash look good and your balance sheet look good, but it's artificial, right? And it can also damage your vendor relations. So we have to do the dance. Yes, balance sheet war, or maybe it's a balance sheet dance. Like, how are we managing both our payables and our receivables to our best effect? Yeah.
Well, and if you don't want to go this direction, course correct me, we can come back to it. But like when I look at, in a lot of these acronyms, I wasn't familiar with, but I did them in the past without knowing what they meant. Back to why I think that people listening in are capable of getting this and then figuring out what levers to pull. But the cash conversion cycle or that working capital, how fast you're collecting your receivables, how fast you're paying your payables, and then how fast you're turning your inventory is so freaking important. And so I was on a call with a client recently, Tracy, and I'll walk you through the conversation we had, and then you can tie it back into your model and how, if when he has it, hopefully not if, but like he's leaning into it, is that so he has $950,000 in payables. I'm sorry, $950,000 in receivables. And so I'll explain to you the numbers and some of the logic I was walking through with him. And then maybe what you could do is explain how we can see that in the 3-statement model that you have, and what he could, like, how we can reconcile the situation. So, because he looks at the balance sheet, he's like, well, yeah, I've got $950,000 in assets for receivables. And then he goes, I'm like, what are your payables? And he said there were $300,000. Okay. And so he's got 300 grand in liabilities. And then we did not cover inventory because he didn't have that, but how much inventory in the turn, but let's just park that over here for a second, because payables and receivables, I think everybody will get, even because if they're a professional services firm or whoever, they'll get it. So I said, well, if he's showing me his balance sheet, I'm like, how many of those are past 30? I don't know. I'm like, well, so great. They're an asset, but like, what if 500 of them are over 30? I said, like, so therefore that sucks because you need that 500 grand. So what we figured out, and he had this metric, but he said, okay, well, he goes, we're collecting our receivables at 35 days on average. So he actually had the metric. So we sat down and we said, okay, we took 950 grand divided by 35. And I don't remember what the numbers were. So 950 divided by 35,000 bucks is 27,142 a day.
Right.
So then I said, okay, we're 27,142 days. Let's say you wanted to get to 29 days. So we would times that by 6. It's $162,000.
Right.
That he should have, that other people have.
Yes. Yes.
And so then we did the payables, and he had 300,000, and he was paying them in 11 days.
Yeah.
Yeah, exactly. I lower your smile. So then we did 300,000 divided by 11 is 27,272. So then if we wanted to pay those at 20, let's do 25 days. So we would times that by 14, right? So times it by 14 is 381,818. So if he just extended his payables, because there's no reason to pay it 11% unless he's getting cash with order discounts, or if he's, but like, push him off till at least the due date, unless it's, due on receipt. But let's assume they're all 30 days and he wants to pay right before 30 days. So 381,800 plus, what was it? 137, 139, 100. Let's just say 137. I don't remember what it was. So that's $518,000 of cash he doesn't have that other people have.
Yeah.
And he knows it because every month he grows, he's further behind because he has other people has his money and he's paying everybody else really fast. But then here's where it gets even more wild, Tracy. I was like, okay, dude, you got $500,000 that you don't have. You're tapping your line of credit for that.
Yep.
And you're putting more money back in. So even though you have a positive net income, you have a negative use of cash. But then here's what gets interesting in the merger and acquisition space. He's not selling, by the way. This is just about measuring the right metrics. When you sell a company, you do normalized EBITDA times the multiple. You get to keep your cash, pay off your debt. So it's net debt. And then you have to deliver a normal level of working capital to that buyer.
Yeah. So
if he were to sell today, he would have to give an extra $500,000 to that buyer.
Yeah. Yeah. Yeah.
So it's costing him $500,000 in cash every month, but then also on the eventual sale, because he can't prove that he doesn't need that 90. So it's just and he just looked at me and I'm like, do you want your 30 grand a month in repeatable distributions? Here it is.
Yeah. Yeah. We measure receivable days, which is a little bit different calculation. We take revenue.
And by the way, let me know if I did any of that wrong.
Yeah, no, I mean, I was following what you were working on, and it's more just because we want to highlight. If you go into QuickBooks, you can pull exactly what's been, is 0 to 30, 30 to 60, 60 to 90, 90 to 120, and 120 and older. And you can, start to see that's my dog.
We got a
Um,
friend.
I know.
Is he correcting you or?
He's like, I've heard her say this a million times. Yeah, same old story. Um, but I mean, I highly recommend keeping track of what's what and who's the slow payer, right? But receivable days and payable days are very similar formulas. If you just want one number to track, like overall, how many days are we getting paid in as a lump sum average, which is just revenue divided by what's in accounts receivable, and that's giving you the turnover. And then you take out, like, is it 30 days or is it, do you want to see for the year, whatever period you're measuring, divide that by turnover, and that's your receivable days. These are, again, like in our spreadsheet, that's all just calculated for you because we know if you just give us your receivables. Same thing for payables. Just, insert payables
Well, and
where
this
I
is
have
where like
receivables.
when I think is in as you get into like how the spreadsheet allows us to make these decisions, it's like, well, if you want more free cash flow, maybe you should come up with a receivables collection process that makes sense, or what's your payables process. So like the processes and the projects and everything spawn out of our desire to have as much free cash flow every month as possible.
And then the thing I like about that, which is exactly, you read my mind, is that if we can say to our receivables person and our payables person, here's the deal. We're at, right now our receivable days are at 90, and we need them to be below 30 for myriads of reasons, right? We already
Hmm.
just talked about it. That it becomes that person's job to call, right? Like you gotta dial
Hmm.
for cash. You
Hmm.
just do, right? Like there are literally people gatekeeping your cash from you in the balance sheet wars, right? So
Hmm.
there are
Hmm.
people who won't pay a 5-digit invoice unless you call them. Period. They don't care
Yep.
what the due date is. You have to call. So you put someone in charge of that, you bring the number down, right? So now we have, as owners, we can kind of like shut the hood of our car a little bit, because we can trust that now we have a metric that's taking into account, how fast we're getting paid,
Well,
and we can dial it down, right? And we don't have to
yeah.
go under the hood every day. We can look at one number and know that it's going in the right or wrong
And
direction.
what I think about the people listening in, the people we work with, Tracy, is they're idea generators. And so, again, I didn't know any of the stuff we're talking about, but back when we had the family business, this was a disaster, like such a disaster. Like, I mean, every other Thursday when we hit the $250,000 payroll, like we went to the cabin and had a Captain Morgan just to take a deep breath so we could do it again for 2 weeks. And we did that I did that for 6 years. And so, but what happens is like, by not doing, I wasn't doing it out of discipline, I was doing it out of need. And we're trying to do it out of discipline for freedom. And but when I say about ideas that came out of this, it's like, because I mean there's a reality, and this is where I don't want to argue with reality, where some people, like we got the client that we were not talking about, Target doesn't pay anything before 60 days. And like, so I had Children's Hospital and Valspar and these big clients, same problems. They're just totally screwing you. They know that they've got the leverage. But what I did is like, okay, if I look at where my cash is and what's the fastest way I can get cash, I went to Children's Hospital and we said, okay, you don't have everything's over 60 and you owe us like 400 grand. If you put that on the credit card, we'll pay the fee.
Yeah. Yeah.
And it's like, okay, well, that was 15 years ago. So that was a lot cheaper than it is now. But it was like, okay, that's a cost of capital. I brought cash in. It was cheaper than my line of credit or other places.
Hmm.
And I didn't want to go raise equity. So like,
Yeah.
but it just becomes like this decision tree. And this is where I like to rely on the ingenuity and the creativeness of entrepreneurs to say
Yeah.
like, that's your choice how you want to handle that. But like, at least the option is presented to you.
Oh my gosh, 1,000% faith in any entrepreneur who, once they understand the metrics and how the metrics are helping them or hindering them towards the goal, they'll find a way to meet the goal. Like there is no question. Like once you give them the right direction to go in, they, like if I'm like, hey, your receivable days are the problem and it's holding you back from getting free cash flow so you can go, take your $20,000 a month in distributions and sit at your lake house, but you got to fix this, they'll fix it, right? Like they'll
Right,
figure it
right,
out.
and 100%. And here, okay, I get so excited about this stuff. Your dog's gonna start grunting again. So I was on a call with a client yesterday. They're in a cash flow crunch, and by knowing this stuff and not being intimidated with it, that's what we're trying to do here. Is so he was sitting on like a bunch of these receivables. No, it wasn't receivables. Well, and it ties into the customer funnel too,
Mhm.
because revenue is a constraint in cash flow too. But
Yeah.
he went in and said, "Why is this being held up? And what's going on with like, oh, things are stuck in engineering." He goes, "So you're just waiting for the person to just randomly determine whether we're worthy of their time or not." And so it's just all this proactive, like call the engineers, see what we can do. And like, we're just freeing up cash on sales, inventory, payables, receivables. And that's the name of the game. And we're just coming up with ideas. But I think what happens for these owner operators, me being included, is intimidated as shit about this stuff, hearing jargon all over the place of why things aren't possible when that is hindering the ingenuity
Yeah.
of
Yeah.
the person that actually knows how to get this stuff done.
Yeah. When we go looking for the cash block, right? Someone's going to say, "Oh, like if we don't understand like how to sort of teach and guide our team, right? They're like our bookkeepers are there to put things in the right category, right? Our controllers are there to pay things at the right speed. But like once we kind of say, "Hey, the goal is to align the payables with the receivables." Okay. And I don't want to hear like we will stop at nothing.
It's not an opinion.
Yeah.
This is not Ryan's subjective opinion. This
Yeah.
is exactly how business works.
Yes,
So
and if we can't do this, we can't continue the business. So the situation that we are in is a no holds barred, line of offense. Like we're going to go and we're going to be creative. We're going to have we're going to have a meeting where there's no bad ideas. We're going to all throw them out there. We're going to think like, oh, I bet if we gave them a 3% cash discount, everyone
like
would
that credit
win.
card
And
idea that I
yeah,
sent through.
yeah. Exactly. I bet if we said, "Hey, can you just give us a deposit to get started?" Or, "Hey, can we'll give you, whatever. We'll give you 120 days on the back end if you need it." Or there's so many different things that that I believe, you can even have a consultation with people who specialize in collections. You don't have to hire the hitman to go out with the lead pipe and, crack people's kneecaps, but they short of that, they have all kinds of creative ways to and it also ends up, believe it or not, one of the cool net effects is it usually strengthens your relationship with that client because you're going to be able to serve them better. It's going to be
And
more
vendors, by
joyful
the
to do
way.
the work. Yes, and
Yeah.
vendors. Yeah,
Yeah. I mean,
exactly.
honestly, like I learned all this the hard way in a time when most of the economy was rip roaring and doing just fine. That's why I think it's like so funny. Cause like now this is like a skill set that's important where like before no one cared about it. But like I watched when like even communicating with vendors on payables, like we would go through our payables and be like, I always joke around. You want to take your payables from 30 days to 90 days, I'm your guy with your vendor smiling. Cause
Yes.
like that's what
Yeah.
we did. It's like, here's the deal. Here's what's going on. And like communication breeds trust. And as long as you're doing what you're saying, like every time that we promised something and didn't do it erodes trust. So you're just trying to be real about what's going on. And this is where like I think Tracy, with your spreadsheet and your model and the education, I've seen too many people where they just randomly think that the CFO or whoever's on their management team are going to do this with the same level of urgency that they want. This is where PE has like PE is ruthless on this, that they really have it. But what I think is it doesn't take a huge time investment when we know it, because effectively you can jump on a call, know where to point, and then the delegation is there, but you know that the delegation is being done with the right level of expectations, not getting all the pushback and not knowing how to deal with the pushback.
Yeah, and when we all focus and rally around a set of numbers and we look at those numbers every month, if not weekly, it, the numbers don't lie. And we're finally looking at the right numbers, right? We're not chasing revenue. We're done chasing revenue, right? We're not chasing profits. We're done chasing profits. We're looking at a set of metrics on the income statement, on the balance sheet, in the cash flow statement that we can say collectively, when we hit these numbers or get them to where we want them to be, now we're humming on all cylinders, right? Like now we know it because we can look back and see how that, over time we've changed them and it's affected us positively.
Yeah, we can
Now
see
we
it.
know how it's going to go forward too. And
Yep. Yep.
that's where you come
Yep.
in with all your stuff.
So I want to make one comment and then I want to talk about what are the metrics in those three statements we want to be looking at. But what I think is possible to get people excited about what you're going to say is, with a majority of my clients, their main goal, one of the first main goals is to get out of the operator role. They don't necessarily want to sell, but they want to be able to see that free cash flow without having that job every day. And then there's this, oh, I got to hire this CEO. And how many failed integrator, president, GM, CEO stories I've had is unbelievable. I think there are two components to the success or failure of this. And I'm kind of thinking aloud, but like this is from a lot of thought is there's one is that the owner operator who knows their business like the back of their hand, their intuitiveness, their legacy, their values, mission, all that kind of stuff. Tracy is the perfect fit for the chemistry of Ryan Tansom Inc. And like, you're it. And then I go away and I just hope you're figuring it out just as much as I hoped I was working it out. And there's no objective way to manage the CEO at all. But like, so there's the chemistry part, which I think generally people that were listening, that we work with and are listening in can nail that if they have an option of choosing from the right chemistry and the right fit. The second part is there's no, like, if the owner operators aren't doing this stuff, someone that is not the owner is not going to randomly care more and figure this all out. So if we put these mechanisms in place, hiring Tracy to manage the 3 statements and the working capital and the free cash flow, because I can measure what you're doing objectively, then I can jump on a call with you and be like, all right, Tracy is the CEO, on track, off track with all 3 statements. And that kind of tees up to like, if I'm the owner and you're the CEO, and we're having this conversation, what are the metrics and what are the numbers in those 3 statements we should be measuring? And then we can further the conversation with how do we project that into the future towards the goal. But like, if we were just sitting down in a month and we're having an owner CEO conversation, what should we be looking at?
What's on the dashboard? It's like, here's the keys to the car with no dashboard. You have no idea how
and
fast
no
you're
map,
going.
where you going?
No map.
No dash, no map. But yeah, it's like, but it's not even no map. It's just like, here's the car. I'll meet you there.
Yes.
Where's there?
Yes. And then what the worst thing is you go to the meeting spot and your hired CEO is in a completely different spot. Yeah. You're like, what was the disconnect? Yeah. Yeah.
You said I'm in Minnesota, up north.
Yeah.
Where's
exactly.
that?
Yeah.
It's north of here.
I thought you meant Manitoba. I thought we were going to Canada. Yeah. I'm in the Arctic Circle. So, okay. So I'll give you, there's 14 key ratios. I can list them off, right?
Love it.
Okay, so and they're divided into 3 categories. There's the balance sheet ratios, the income statement ratios, the operating performance ratios, and the cash flow ratios. Sorry, there's 4 categories. Did I say 3? On the balance sheet, we measure the current ratio and the debt to equity ratio. Okay, current ratio we call liquidity, and that's your ability to pay the bills, right? So very important. And the debt to equity ratio is your safety. And that's your ability to withstand adversity, meaning how bankable are you? Could you get a loan if you needed one? Right. So debt to equity is a key ratio for
and when just like a house, right? Your debt to equity, when you buy a house with a conventional loan, you need 20% equity and 80% debt based on the income that you make.
Exactly. And we all know the banks look at other things as well. But if a lot of these, if we're going to, because we keep things simple, we try to choose the canaries in the coal mine, right? There's lots of other things, but we want to give you the ones that are going to like probably be like tip of the iceberg, like your harbingers of danger or success. Okay?
Well, and as you keep going, like, but how in my words would be, it's the first principle where if this is wrong, everything else extrapolates from that. So that way it's not a byproduct. It's literally everything's a derivative.
Yeah. Yeah. If this is wrong, probably a couple other things are wrong too. So then we can dig, but let's look at these. And if they're not wrong, we'll continue on, right? Because we're busy.
So we got liquidity ratio, debt to equity ratio on the balance sheet.
Yep. So yeah, liquidity and safety. Income statement. We have 3 levels of profitability on the income statement. I am asking you to measure gross profit margin, operating profit margin, and net profit margin. And notice that we did not say revenue and we did not say profits. We're always measuring it as a percentage of revenue because the classic example I like to say is, Ryan, would you like to have $5 million in profit? Yes or no?
Is that a $800 million company or $1 million company?
Yeah. Or a $50 billion company, right?
I want to be a billionaire.
Yeah. So $50 billion company making $5 million is like almost out of business, right?
Yep,
so we wouldn't know that unless we took $5 million as a percentage of $50 billion. Yeah. So context matters. And the 3 levels of profitability, most people measure net profits. right? They care about the bottom line. They call that the bottom line. The problem with that is that if the bottom line is broken, it's because we ignored the other two lines.
Mhm.
So the bottom line is kind of meaningless at that point. We got to nail the first line, which is gross profit margin. If we nail that, we probably have a pretty good fighting chance at operating our business at a profit. And then there's
Mhm.
so few things that come between operating and net profit. So then it sort of trickles down. It
Do you wanna
doesn't
go
sort
do
of,
you
it
wanna
actually trickles down.
maybe you were gonna do this, but do you wanna go into what is in those? And one of the things that I have overcome in my growth personal journey, my personal journey, but you validated it, is everyone has 1,000 terms for the same effing thing. And so
Yes.
it's like revenue, sales, this, or then there's gross profit, cost of revenue. And so like I think
Yes.
you and I have both landed on there's all this jargon, but it doesn't change the fact that we're measuring the exact same things if we just like translate what is in it.
Yeah.
So maybe if you want to
Yeah.
allude or give us some context of those different terminologies, but then what are you actually specifically referring to so people don't get lost?
Sure. And without making it a bookkeeping or an accounting class, let's just kind of say this in broad terms too, just so it
Yep.
lands, right? Like, because people will argue with me with what goes where. And I'm not really interested in that because I just want you to get an understanding of what we're talking about, right? So, um, we have revenue, right? That's all of the money. People call it sales. Sometimes people call it income. Um, it's it's any of the money that you get from operating your company is in our world we're going to call
Your
it revenue.
customers gave you money.
Yeah, you did something, you got money. Okay, you get revenue. Um, from that, the first things we subtract are the cost of that revenue. So anything that we had to spend in order to make that money. And a lot of times, service based businesses argue that they don't actually have any cost of sales. So if you go in and you look at a benchmarking database, you'll see some industries don't even measure gross profit margin. It'll always say 100% because they don't think that they actually have any expenses tied to creating that revenue, which in my mind can never be true. There's
Well,
never
and,
a
and I'll give
business.
you two comparing. And we'll go back for the listeners in here. We'll, like as we after we do some of this explanation, we'll go back and summarize the KPIs and make sure we keep going. But I think this is an important context so that way we're not losing people and people are arguing in their head or talking to someone else. To compare and contrast the exact example you just talked about for cost of goods. As I built up multiple business units, my old company and the couple startups I've had is what does it take to how much is it? Can you deliver this product or service without that cost? If the answer is yes, then it goes into overhead or SG&A, and you will get to that. But what's so fascinating, Tracy, with my two lines of business at the family, uh, the copier technicians for servicing copiers, all of the payroll was in cost of goods. So all of it, that was best practices for that industry. So it was them, it was their vehicles, it was their health. I mean, it was all of that stuff and more. But as it relates to just payroll, but then in the IT services space, all of the payroll was in overhead or SG&A, and then the time tracking tool actually would take an hour on their burden rate and apply it to cost of goods as they were doing services, which convoluted it. But I'm just explaining like I had one business with two different business units that treated this situation different. You know how many arguments we got into
I can only
about like
imagine.
trying to figure out whether we were making money or not on
Yeah.
this shit. It was
And
ridiculous.
let me put it this way, like, whatever you're gonna do, just do it the same way every month, right?
So
And
you know what you're talking
understand
about.
what's in there. Understand what's in there. I get guys, I work a lot in the moving and storage industry. So if they have storage and they have a warehouse and they pay rent on that warehouse, they want to claim rent as a direct expense, right? They want to put that in a cost of goods. And I'm like, well, you know, if your warehouse is empty, you still owe the rent, right? So it's not really like whether or not you have storage in there or not, didn't really it's going to artificially decrease your gross profit margin when your storage rates go up and down, right? So we get into these like esoteric battles. It's a really great example of how, despite numbers being black and white, accounting can be very gray. So pick
Ooh,
a
I like that. Yeah.
yeah, so pick a place to put it in there, know how it's going to affect, like, okay, rent's a really big chunk of money and it's, either in our operating expenses or in our cost of goods expenses.
Because the goal is to be able to compare and contrast for the story, and we need to be able to have the same agreement with our leadership team and the ownership team.
Yeah, yeah. So however you want to measure this, like put things where you think we can, move a lever or, make something change in order to affect this, right?
Yep.
Okay, so
The 3 KPIs, the 3 profits in the income statement. So go back to now we got some clarification or any other terms or clarifications of what goes into those 3 buckets.
Right. So gross profit, and it can also be called, so the things that are in there we can refer to as your direct expenses. That's another term that gets thrown around because they're directly tied to revenue. You had to, you couldn't do the revenue without this expense. And cost of goods, cost of sales, those are the main ones. Okay. I would argue that even if you're a service-based industry, you have cost of sales. Okay, because someone's working and needs to be paid to deliver that service. So if you're like programming, if you're a software development company, it's probably the programmers, right? Their billable time is probably in that cost of sales. Okay, so once we've paid for the things that we have to pay for in order to deliver our goods or services, what's left over are our gross profits. Okay, and if we divide the gross profits back into revenue, that would be our gross profit margin. Okay, maybe it's 50%. Okay, let's say it's 50%. So now we have 50% left over to run our company. And so of that 50% of revenue, we take out our operating expenses. And these can also be called your indirect expenses because they aren't directly tied to creating revenue, or you had said SG&A, overhead,
Sales, general,
Yes.
general administrative,
Yeah.
OpEx, just all that.
Yeah. It's basically, those are all synonyms of each other, okay? And once we've paid for those, and usually, just to give everyone context, usually we have a handful of things that go into gross profit margins. Like the direct costs are usually less, fewer line items, fewer charts of accounts, and the operating expenses are usually long. There's usually a lot of things in here. Okay. So just if you're kind of trying to picture your income statement while you're listening, that's what you're looking at, right? It's usually like all that stuff: travel and entertainment, meals,
IT
utilities,
services
IT
and
services, legal,
marketing,
accounting,
legal. Yep.
marketing, office managers. Like if you have a car that you're using, maybe part of that goes towards direct, but it's probably otherwise administrative. And so there's all of these things in here. And then when we're done paying for all of those, let's say in a good world, that's 30% that we've taken. So now we've spent the 50% on our direct expenses or that cost of sales or cost of goods. We took another 30% to run the company, our operating expenses. So now we're left over with 20%. Out of that 20%, there on your income statement, there's usually like 3 to 5 lines that exist there. And it's the non-operational income or non-operational expenses that hit between operating and net. So those are things like little interest income or interest expense, or when you get that PPP money or the ERC money. These are things that you got because those are the goods or services that you sell, but it is money that came in. If you sold an asset and you made some money on that, you're not like in the business of selling desk chairs and computers, but maybe you
It's
did
not
sell
part
some.
of your normal operations. Cause let's go back to why are we looking at this stuff? It's like, I did something with a good or service and it cost me something. I had a bunch of overhead and then I was left over with whatever. Random stuff is coming in or out based on different things that are moving around that we need to bifurcate out of that so I can have a true picture of my operating business. And then there's all the other stuff that's happening.
Yes, it kind of protects you from seeing things through the wrong lens. And what's interesting about what can come in between operating and net, that levels 2 and 3, is that the operational income, it could be positive, right? Like you could get more money, but we didn't put it up in revenue because again, that's not what we do or sell. Like, so you don't want to see an increase in revenue, and that's going to affect these gross and operating profit margins. We want to see it more towards down the bottom. So the last piece is we add or subtract any of those non-operating incomes or expenses to get our net profit. So I would argue that any strategic owner operator of their business should care about these in order from top to bottom, right? Because if you don't nail your gross profit margin, you didn't give yourself enough money to operate, and you will definitely not have enough money to have a net profit. And whatever comes in between operating and net it's
It's
just
usually more
not,
random.
it's
I mean, it's
random. Yeah,
Yep. Yep.
I mean, maybe it's
Well,
something meaningful to you. There's always an exception to that,
I'm not
but
saying it's not. I'm not. I think there's a difference between meaningful and random. Like if you
yes.
sell something and you got some income, that doesn't mean it's not meaningful. It just means it doesn't have anything to do with the sustainable operations of your business.
Yeah.
And I think, what I say in every one of my workshops that I do, Tracy, is like, if we all put our net income in front of each other right now, that would tell me literally nothing about your business. Because
Yeah.
the whole goal when we're trying to look into the future and for ourselves, because it's all the same thing. We want to look into the future for ourselves to generate free cash flow, which we're going to get to. But if we can't see the future, we can't explain the future to a buyer,
Yeah.
and all we're doing is telling a freaking story.
Yeah.
And if we don't know how the story is told in the numbers, like I remember when I was trying to do our banking and stuff, I'd like pull up PowerPoints and do
Mhm.
whiteboards, and they'd be like, "Great, you're a good salesperson. What is it? Show me the."
Show me your numbers. And you're like, "Oh, I don't wanna talk
I don't
about
know what they
those."
mean.
Yeah. What do you wanna see? The, the thing when I go, I work a lot with CEO groups, and we take everybody's financials 2 times a year, and then I run all of these metrics that I'm telling you, and I rank them, like who's winning, like who has the most liquidity, the most safety,
Because you've got the same industry that you're doing this in,
yeah,
right?
because they're
That's
all
why
in
you
the
have
same
it.
industry, and we have a common chart of accounts that I make them conform to. So when we rank them, and I give the award for number one, number two, number three, I don't even rank net profit. I don't even rank it. I'm like, I'll show it, but it is so meaningless to me that
Mhm.
you can manipulate this to look great. You can manipulate this to look bad. I mean, we all know how it works at tax time. You don't
Yeah,
want
we
any
do.
net profit, right? You want no net profit. So
Yep.
we're going to do all kinds of things to put expenses in. And, so I want to see your gross profit, and I want to see your operating profit margins, right? The fourth level, if for independence by design, would be if we added a fourth, and we don't have it official, but it would be EBITDA, right?
Yep.
And
Normalized
that's
EBITDA, more
normalized
specific. Yep.
EBITDA.
Yep.
Yeah.
Yep.
And that would be one that's going to be a little bit higher than your net, right? Or possibly higher than your operating, depending on what's in your income statement,
Yep.
because you're going
Because
to
you're
add
just
back.
you're going back to like normalizing the one-time expenses or
Yeah.
investments. Because like back to like just how that shows up and how it impacts net income is if you and I own a business and we go spend 100 grand with a marketing agency to build out our website, and we do that once, it'll be in the marketing expense in OpEx, overhead, SG&A
Yeah.
or whatever. So that 100 grand would be there, but we wouldn't need that next year. So next year it will be more. So
Yes.
we'd be
Right.
adding that back and increasing that net income.
Yeah, you certainly didn't need to do that necessarily to probably even survive as a company, and so you kinda can, like, say,
It's
it
an
would
investment. I
it's an
mean, like you
investment.
would need to do it for the long-term sustainability, but you don't, it's not going to happen every single month.
It's not gonna happen every single month, and the other interesting thing about that is because it doesn't get classified as an asset, it could or should actually live on your balance sheet, in a different world. But let's not get into the weeds of
Yeah, I was
accounting
going to
today.
say, careful there. Yeah,
But
I
because we
agree.
do wanna recognize, that was an expense, that you wouldn't have to do over and over
Yep,
again,
yep.
we can normalize EBITDA. That would be a considered fourth level of profitability. But again, when we work at 60 Minute CFO, we're really working more on a day-to-day operations, less around valuation and exit. So,
Yep.
okay.
But sorry, just so kind of to see if I'm tracking. So you got the current ratio on the balance sheet, the
Mhm.
liquidity ratio on the balance sheet. Then on the income statement, you go from gross profit down to then operating
Mhm.
profit, down to the net income, down or
Or
no,
net profit margin.
net
Mhm.
profit margin, then down to normalized EBITDA. And the
Mhm.
reason that you have now inserted this into your model for my clients is because if we're tracking that every month, we're just building the story. It's essentially just building that footnote for someone to say, what did you do over the last handful of years to track what worked or didn't work? But to your point, it's not about selling today. It's just about tracking that story that's going
Yeah.
on. But you
Yes.
have those four layers that every month you should be looking at those four along with your two on the balance sheet. And that's, back to the owner operator meeting.
Yes.
This is the stuff that we're covering.
When you meet with your CEO that you have deputized, you say, what's going on with liquidity? What's going on with safety? What's going on with gross, operating, and net? And month to month, we're going to see the story, right? It's not going to be static. Nothing is. But the two things that happen are, for one thing, we're working out. We're working our muscles. right? So we want to look at it on a monthly basis because if nothing else, if you don't use this information, you lose the information in your mind. You lose the meaning of it, right? Because we're busy. We're running
Yep, yep,
manufacturing
yep,
companies or
yep.
whatever we're doing. And for the other reason, it's because you're getting to know your business and how it actually looks in January, in February, in March. And we're going to be able to identify like what happened. And oh my God, that was that one big client.
Yeah,
And
before
it's,
I was gonna say
yeah,
because I know you're gonna go into analyzing and reading trends here in a second, but like so but I want to finish the cash flow statement KPIs, and
yeah, we got
then
to get, yeah.
but I think but what you're and we'll get into the forecasting and the reading of this stuff and the analyzing, but when you say like the way I think about when you're going through these KPIs, we have to have that forecast to know like what the hell does this mean in context. So not only are in relationship to the revenue as the KPIs, but also like budget to actual to our goal. And if the goal isn't clarified in 1 year and in 5 years specifically, then we have no idea what the context of back to like we got in the car and we stopped at a rest stop and we're like, are we there yet? Who knows?
Who
We're at a
knows?
rest stop. It's the month, but so
Yeah.
we'll get to the forecasting and they're analyzing. But let's nail down the last couple KPIs.
Okay. Yeah. Okay. So then we go into our operating performance KPIs, which include, we've already covered two of them, but the first one is return on equity, right? So that's our return on how much we have invested in our company, our equity. And we always want to monitor that because there's all kinds of places you can get return on money in the world. And usually, most of the time, your business is going to have the best return. But if we end up having a lot of cash tied up in the business and we see that like it's dipping below what we could get in real estate or stocks or whatever else we want to invest in, that's a red flag, right? So we look at, and the nice thing about return on equity is it's really the counterpoint to debt to equity because debt to equity measures our risk in the business, right? Like how risky, like how much risk have we taken on by taking on other people's money?
Yep.
Return on equity is the reward,
Right.
which
And
is nice to see every once in a
I'm
while.
gonna no, I'm tracking you. And so I've spent the last 3 months like so in the weeds on weighted average cost of capital and the blend of equity and debt that and then return on equity. So I'm going to drop a seed here for the listeners because this conversation we're having is going to be the first of a train of interviews. And I got Ken Sanjanero back on about talking about the return on or the weighted average cost of capital and internal rates of return. And I was asking him, and we'll cover this in that interview with him, is so like return on equity, like that's the name of the game. To your point, we're like we want to be getting a higher rate of return than fixed income, than the public markets, and like because we're taking the risk, so we want that return on equity, and we want to be able to track that. However, Ken, because he's a finance guy, and it's from operating in PE world that is the financial trickery is verbatim what he said can
Yeah,
be done on return on equity because of what the hell are you putting in your balance sheet?
in your assets. Yeah.
So like if there's goodwill, and goodwill usually comes because you bought a company or something happened, but for example, if you had 20% or free cash flow, it's 200 grand on $1 million, but like are we agreeing that the $1 million is real?
Yeah.
Right? So like I say that because if the people listening in and they're doing this work and like they're being real with what the F is in their actual balance sheet, then they can believe that number more.
Yes. Yes.
It's just like they're like if we look at the public markets or private equity, there's a lot of smoke and mirrors of what the hell that is.
In the book, on the chapter on the balance sheet, we talk about balance sheet adjustments, and it's something that I think is really good. It's an astute point because again, like numbers are black and white, but accounting is gray. So we have to know like if we're especially because you said comparing ourselves to the forecast and also when we compare ourselves to the industry. So if you can get industry averages, it's good to know what could or could not be in those numbers that you didn't see the balance sheet. You didn't get a line itemized thing. You got debt to equity and you got liquidity to
Right.
look at.
Right.
You got return on equity to look at. You just don't know what's in their
Right, right,
equity.
and then
Yeah.
the last comment, and before you keep going is, and then I'll be talking about this in a lot more detail with Ken. Is technically the more debt you have, the lower the weighted average cost of capital, and therefore the higher the multiple. So it's super effed up. And this is what I've been literally going down the rabbit hole, Tracy, on for like 4 months. Cause look at your face. So here's where I landed. And I literally, Ken and I are actually doing another podcast interview because I did one for with him for 2 hours this week.
Oh my gosh.
And he's trying to get up in my chair. He's not a lap dog anymore. But so Ken, I was like, okay, so bear with me. This is a little sidebar, but we'll bring it back on track for everybody. Hopefully everybody can follow this. Is like, so the weighted average cost of capital is the cost of equity. So like, which effectively for owner operators listening in is their desired hurdle rate or their desired rate of return. Because they didn't raise money from someone. Like if they raised money from you and you said, I want 20%, that would be their cost.
Yeah.
But because it's themselves, it's their target is actually their cost.
Yeah.
So it's like, okay, well, this is your this is your cost of equity, and there's risk inside, and that's where that build-up methodology comes from.
Yes.
So we say, okay, well, here's, the build-up methodology. We weren't going to go into that right now. The build-up to get your rate of risk for equity, that it needs to be your hurdle rate based on your goals and the risk you're taking in your business and your operations. And then you would blend that with your debt, and the debt is cheaper. So technically, the reason that private equity fully loads up everything with debt is because it increases their multiple. Because if we said that the weighted average cost of capital is 20% with the blend of the two, 1 divided by 20 is 5. That's the multiple.
Yeah.
So we go, okay, 1 divided by 20 is 5. Well, the way we would lower that from 20 to 15 is take on more debt.
Yeah.
Which is freaking like, it makes sense. Just like you and I wouldn't pay cash for a house.
Right.
Like it's the exact same thing. We want to take on $1 million house. We want to take 800 grand out in debt so we can use the other 800 grand to put it into higher return stuff. But as an owner operator, we care about free cash flow. So technically the shit that everybody measures is the opposite of the name of the game that you and I are trying to promote.
Yes.
Which is free cash flow after debt, taxes, working capital. And technically that's increasing the risk. The whole thing is so mind-numbing to me, Tracy. It's like, wait a second. So like, because every dollar of debt paid off between now and an eventual sale goes dollar for dollar to the bottom line, just of equity, just like your house. You pay off the debt and it goes into your bank account when you sell.
Yeah.
But when the person buys it, they're incentivized to completely saddle that with as much debt as possible to reduce their WACC and increase their multiple.
Yes.
And so it's just mind-numbing.
It's a bit of a shell game, really, right? Like it's just where did it go?
Okay.
Where did it go?
Right. So, but this is why I'm going to come back and land at home and keep us back on track. Is it's a bit of a shell game for the M&A markets, which is why like I have so many of these bad stories about people screwing shit up, because the name of the game for PE is not free cash flow.
Right.
It's hand the flaming bag of whatever onto someone else that is responsible for free cash flow. Your clients, people listening in, the only thing they give a shit about is free cash flow and a return on their equity.
Yes.
So like, we're trying to like bring the home to say like, for you all who like, we have to measure what you're talking about. And then if we eventually go to sell, we have to play that game and like manipulate the numbers to get the story bought in. But like, I'm sorry.
We're playing. I think the first piece of your framework is choose the game you're playing, right?
Mm-hmm. And choose the game you're playing based on your cash flow and equity goals. So like the cash flow and equity goals become the peg of the 3-state model, saying, I want to make 300 grand in free cash flow while I run this company, while someone else runs it. And I eventually want to net $5 million.
Yes.
Over what time period? That then bakes into the 3-statement model you're talking about. And then back to then the cash flow ratio you're talking about is important, because if all of this, being back to what you said, is return on equity, if we're real with what we put in our balance sheet.
Yes.
If you're lying on your balance sheet, you're lying to yourself, and then it's only impacting yourself. Is my guess. My long monologue.
I also like, while we're talking about lying to ourselves, like let's also make sure that we're not artificially inflating our profits by not paying ourselves. Right. Like there's all kinds of ways that you can be like, oh yeah, and I don't take any money out of the company, but like we got a 30% net profit. And it's like, but did you pay yourself? Like how much are you paying yourself? And then on the flip side, you can also, exercise the adjusted EBITDA model, where it's like, well, you're paying yourself like astronomically high amounts, right? Which wouldn't translate to the person.
But let's talk about how that hits the income statement, and then go back to your return on equity. So if you're not paying yourself, let's say Tracy's worth 250 grand, that's not in SG&A or overhead. So
Yeah.
you're missing out on the 20 grand a month in expenses, roughly 21 and a half, whatever, the 20 grand a month in expenses.
Yeah.
So you're like, that's your artificial inflation. But
Yeah.
if you normalized it, you would have to, if we bought a company, we'd have to hire someone. So like that would
Yes.
have, that expense
Yeah.
would have to go back into, that's where it would actually reduce EBITDA.
Your EBITDA.
So
Yes.
you're reducing it. But then if you actually have a $500,000 salary because you have a partner and you're
Yeah.
splitting distributions, you're trying
Yeah.
to screw your partner, you would have to reduce that overhead.
Yes.
But
Yes.
the way to, and this is really important as we then go into the cash flow statement, the way to identify your free cash flow as you're about to get into this is
Mhm.
we have to have all those forward profit margins that you measured in the income statement with someone else at the 20 grand a
Yes.
month. And then
Yes.
we then take our desired income away from optimizing the income statement into optimizing it from free cash flow in the cash flow statement. So as long as there's 20 grand a month for the CEO, that's not me.
Mhm. Mhm.
And as long as I can predict the 20 grand a month in free cash flow after all of this is being done, then I'm down here
Yeah.
in the free cash flow. So
Yes.
I think
Yes.
this is helpful because so many people get so confused on this stuff. It's ridiculous.
It's hard. I mean, until you've also, like I said, kind of used your muscle and looked at your own numbers, and it's you and I can chat about it, and people are just like numbers soup, words flying all over the place. The thing I really like about our spreadsheet, even though I know a lot of people have opened it up and had like instant
brain
overwhelm,
aneurysms.
yeah, is if you take it step by step, year by year, month by month, I promise it is easier than what you're doing.
And you can even
as an
drop down the
operator.
words that you're comfortable with.
Yep,
It's like, oh, I actually like this word better. Okay, fine. Here's the
I
drop
know.
down. Pick that word.
I know if you're like partial to the other terminology, we have a little drop down and you can change it. So, okay. So
Return on equity. Sorry.
okay. So return on equity. And then we kind of touched on these already. Receivable days. It's a direct driver of cash flow. Inventory days is also a direct driver of cash flow. I know people, especially during the pandemic, wanted to hoard inventory when there were supply chain issues. That affects your cash flow, right? When
Mhm.
inventory is an asset, and when assets go up, cash goes down.
Yep. Yep.
So we have to optimize the number of days we have of inventory in stock and match that to the turn, right? That how fast it's going out the
And the
door.
way you're getting at is saying, we're going to sell X amount next month, X amount of those units. And therefore, that's how many days we need because we're going to sell X amount in each month. And we now have 30 days of inventory.
Yeah. The actual formula for days of inventory is direct expenses. It's kind of unintuitive, right? You would take your cost of that inventory. Okay. You would divide it by the amount of inventory. So cost of direct expenses divided by the amount of inventory. That's how fast we turn that inventory over. And then we have the day, like let's say it's a year, the 365 days divided by that turnover is going to give you your inventory days. And what's cool is like you can say, well, based on our suppliers, we know we need 120 days of inventory because it takes 120 days to get it. So that's the safest thing so we don't go out of stock. But if it takes you 30 days to get your inventory and you have 120 days of inventory, well, you're just sitting on that's cash.
And this is where,
tied up.
but like back to data analytics and decision making as an owner, insert pandemic where it went from 30 to 100.
120. Yeah.
Yep. And like I know I had some clients at that time, Tracy, where that's exactly what happened to them. And actually, the guy that I was telling you about, like his PE experience sucks now. Their shipping containers went from $2,500 to 18,000, and it was like, and then he goes, like he was telling me the inventory stories of like shipping fertilizer in enormous container, like literally filling up ships instead of the containers to get it. But it's the question is, okay, well, if we see the price going up over the next couple of days or next couple months, do we want to increase the inventory days to beat that price so that way we can have higher margins? But if you don't, the easy answer without any more context is obviously we want to buy more at this cost, but if we don't have any cash,
The question is, what will it do to our cash? Yeah.
always,
You know, spoiler alert, but in our model, you can play with that, right? You can say, well, if I increase inventory days to 120, oh, well, we would have negative cash, but you know, what would we do? We can increase liabilities. You know, that's when then you put that problem out there and an entrepreneur will solve it. But no one likes a surprise. So we want to know the problem in advance of making the decision, right? We want to know what the downstream problems will be. So yes. So I mean, same thing. Like if we get lazy with the receivables, and if we get um, lazy, but to our debt, to our benefit with the payables, that's the next one, right? These payable days. What will it do to our cash? So those three things are so like cash driven if we're like really talking about cash, right? Because they are those invisible things that don't live on the income statement, not invisible,
Yep.
but the things that we don't look at on the balance sheet.
Yep. Yep. Yep.
Okay.
Yep.
There's two more operating performance before I get to your favorite, the cash actual ratios. So um, survival score is the fifth operating performance ratio. Survival score is our word for the Altman Z score. The Altman Z score, Jay Altman was a banker a while ago now who did a study on companies that did or did not go bankrupt. So it's a predictability. It's predictable of how close you are to bankruptcy. And if you're 2 or below, your likelihood of going bankrupt is way higher than if you were above 2. So what's cool about it is it's a 4-part formula. I'm not going to list it out. No one will follow it. And each of those are multiplied by a coefficient. And so it's weighting of it. Most of it lives on your balance sheet, again, which we don't even look at. It does take into account net profits, but
When you say we don't even look, like in theory, most of us don't look at it. That's what you're saying. Like,
yes.
Yeah.
No
so
one looks at
this
your
is how,
balance.
yeah. So this is how important it is. Even though we don't normally look at it, this is where it actually
It's
resides.
the predictability of your bankruptcy.
Yep.
Yes.
Yep.
And what's just cool is, again, it's kind of like that canary in the coal mine. Like if something bad's going to happen, the survival score is going to tell you. Now, the interesting thing, I've worked with companies that have gone bankrupt, and they will tell me, they're like, my survival score's been 2, it's been 1, it's been 0 for so long. I don't think this is real. Like I'm still around. Well, bankruptcy is very slow until it's fast.
You ever heard of the book, Gradual Then Sudden?
Yeah. I have not heard of that book, but that's basically
it's about currency collapses. So it's a slightly bigger picture than this, but it's all of the bankruptcies and all this. I mean, the real estate crisis. I mean, just think about it. Gradually, then wham.
Yeah. So I also like to tell people it's your number of options available to you, right? As this number gets lower and lower and lower, you have exhausted, you're probably not profitable. You probably have, your assets are probably dwindling.
Tapping your line of credit,
you're
pissing off your banker.
Tapped. So your debt to equity is through the roof. You probably have no equity. You're probably actually quite literally upside down in your business, and you're making it work because you're an entrepreneur. And so you have like begged, borrowed, probably not stolen, and to keep the lights on. And then one day you realize, like,
I bet you if we were to go back to my dad and I's business, we were at 0.2 for 6 years.
Yeah.
Because the amount of Captain Morgan we drank, and by the way, I moved on to the other things. That's all we could afford back then.
Yes.
So it was like 0.2 because the amount of stress and anxiety and all that shit we were dealing with, because it was payables, receivables, inventory, talking to the bank, and it was just every 2 weeks.
Yeah. Yeah.
I mean, and like you can make that work for a long period of time, but like then what happens is people get into effed up situations with financing the receivables and different other like financing mechanisms that like it's debt cocaine, and good luck ever growing your way out of that. I mean, or it's just,
it's to get on top of it is nearly impossible. I mean, really, it's thank goodness for bankruptcy at that point, right? It's like, thank God this exists.
You know what I want us to keep going, but like, you know what? So you and I work with too many of these people, and we've been them, Tracy. What do you think in your past, in your situation, would be worse? Telling the world that you failed and had bankruptcy, or the actual financial implications of bankruptcy?
Oh, it's always the ego.
I think that's why, like, honestly, Tracy, when like I'm recently just finished up Madoff on Netflix, or any of these, Enron, the smartest guys in the room, or like any of the financial engineers right now at the top. Road to hell is paved with good intentions. I'm just going to do this real quick. I mean, maybe Madoff is a total narcissist, crazy psychopath, but like, I just think like it's so easy to say, I have X amount of employees and the vendors, and I'm just going to quickly fabricate this one PO this one time. Like, I don't know. And so like bankruptcies are there for a reason, but like
I think it's also like the whole world it's their opportunity to be like, I told you so, right? Because they always say like, tell your friends and family last that you're even going into business for yourself, because they're going to try to protect you from ever taking that risk. It's such a big risk.
And back to why are entrepreneurs the biggest risk takers? It's usually because we have to prove something to ourselves or to our family. And so like
Yeah.
it's like literally the exact psychological opposite of what we need without internally
Yeah.
combusting.
No, it's like our well, and it's our worst case scenario to not have achieved that. And I love like Sarah Blakely who says to celebrate your failures. She's a big proponent of like, well, and she's like the youngest female self-made billionaire
She's the
in the United
Spanx, right?
States. Yeah, she's the Spanx girl.
She happened
Um,
to start her career selling faxes and copiers, by the way.
Yes, she did. Yes, she did, Ryan. All of the most brilliant business minds start there. So,
Oh, funny.
she says to celebrate your failures, and I like to remember that like this is not an ego game. This is because I love solving problems, right? I love helping other
Love
people,
it.
and I love
Love it.
solving problems.
Yep.
So yeah, like bankruptcy would be a huge sad thing, and it would be hard, but you know,
But technically
you
the
go on.
reason we have LLCs and corporations is to avoid the personal destruction. So I mean, there
Yes.
are benefits in America to actually having those protections, even though it sounds horrible. Anyways, we don't have to keep talking about that.
And let me just say that with this handy dandy survival score that I will calculate for you, you can see this well in advance. And I always tell people it can change really fast. This is not a death sentence. Like I said, like it's gradual, it's a slow process. So let's get a hold of it and
Yep.
change it for the better. And
Yep.
it's fun and cool when we do that. So, okay,
Yep.
the last operating performance ratio is revenue per admin employee, which is widely misunderstood because people are thinking that this is the revenue an admin employee would generate, and it's not. So it's taking a look at your workforce and saying which of these people are non-revenue generating, right? So it's like your managers, your office manager, anybody who isn't billable, right?
Mhm.
And it would be
Or
salary.
part of cost of goods.
They are not part of cost of
So it's
goods,
not revenue generator or part of cost of goods.
right? So they are overhead. Okay. They are like the people that just cost us money. They aren't making us any money. And so we take our revenue, okay, our top line, our income, sales, whatever we like to call it, and we divide it by this number of people. And you might even come up with a fraction, like if someone's part time or they're part time revenue, part time non revenue. Okay. So
Mhm.
you're going to try to get a count on these people. You divide that. And what that gives you is a number of dollars. Like let's say it's $500,000 of revenue per admin employee. What's nice about this is you're going to look at it over time. You're going to say, well, when we started, it was $1 million of revenue per admin employee because there was one admin employee. Then we grew and we grew and we grew and we grew. And when that number went down and down and down and down, and now we're not as profitable anymore and times are really hard and we're barely making ends meet, but we certainly couldn't cut Susie or Joe or Bob or Sue. Um, and it's this emotional, cloudy, murky area, right? Because our employees, we never really want them to be family, but they become family, right? Like
They
it's
become family, or they are family, or
yeah.
they're literally in the community where when I go down to church or whatever it is, like there they are.
And they're good people and you like them and you regard them highly and you certainly wouldn't want to ever have to disrupt their world and, let someone go.
Yep. Yep.
And this number just gives some objectivity to what is otherwise very subjective. And we know there's also the opposite problem where this number is way too high and everyone is burnt out on their like last leg ready to ditch you because you haven't hired anybody to help support them. So
Yep. Yep.
it's a really great measure that takes the emotion out of it and we can just say listen, like our ideal number was in 2021 and we all knew we were firing on all cylinders. Everyone was highly skilled and just the right amount of busy. And that number was 650,000, right? So it's going to be a unique number to you. And it's important to track over time in order to figure out what that number
Yeah.
is.
Way better than just random revenue or your checking account. I mean, it's a really cool KPI.
Yeah. Just because we can afford them too doesn't mean we should have them, right? Like there's just this like optimal place.
And it's important that you're taking out the revenue and the cost of goods people, because I think a lot of people, when they do the revenue per employee, it's like, hey, it's 250 grand is the standard. It's like, well, back to the double clicking, asking further questions of who's in that number.
Yeah. Who are these people? And it could be that there's like one guy pulling all the weight for these 10 non-revenue generating people. It's not a bad number. I think people like to use it because it's easier to calculate, quite honestly. You just grab up everybody. But when we get a little more, yes, double click in, it's going to give you, it's that blind spot. It's a potential blind spot too. Okay. So those are our 6 operating performance. Let's talk about the 3 cash flow ratios. And it's important that those are last because they are derived. Right? Like once we master the 11 that I just listed off, really what we're talking about is like oh, well, of course, the result would be these three cash flow ones. So the
Hmm.
first one, and in 60 Minute CFO, I'll just let everyone know if you're familiar at all with cash flow, we've simplified what is usually operating, investing, and financing cash flow into just operating and financing cash flow. And that's purely for simplification reasons. We didn't get rid of investing, it's just grouped into operating.
Do you want to explain what those are? Then
Yes.
that'll give some context to why you did what you did.
Yes. So operating cash flow is the change in cash from operating activities. Okay. What you do. If you sell
Hmm.
widgets, it's the amount of cash that you spent or made on widget or gained, the increase or decrease in cash based on selling widget activity. Investing cash flow would be a part of, include that in operating cash flow, but the amount of money that you spent or lost or made in investing activities, buying things like anything really, stocks, real estate,
Well,
things that are
and so
investment.
I think here's where I've made the clarification for my clients on this, Tracy, and I think it has just to do with the type of clients that you and I work with. Like, public companies are sitting there with, like Michael Saylor, who's like my hero.
Hmm.
Like, he had all that money sitting on his balance sheet and he didn't know what to do with it because he couldn't figure out a rate of return in his own company. And you're not allowed to put and as a public company, you're not allowed to put your money into other public companies. So like you're sitting there with idle cash, and the general situation with you and I's and our clients is they're not sitting there with so much cash they don't know what to do with. It's either they're distributing it to the owner for their lifestyle and distributions, or they're putting it right back into the business. So I think you just take, so the operating cash flow is like, here's how I always say, you did all these things last month.
Yes.
This is what is left over based on your operations.
Yep.
Then that's where I always say, then the decision tree, then, because so if you collapse that into investing, because it's a margin of error, I think, for the people we're
For
working with. Is that a fair?
privately held owner operator companies, exactly why we did that.
Yeah,
Yes.
yep.
It's
So
just,
then,
yeah, it exists for the
that,
public. Mhm.
right. So, and therefore that operating cash flow line is where the ownership decision tree starts.
Yes.
So it's like you did all of those things with the operations. It results in this. Now there's
What?
more decision. There's
Yeah.
now more decisions to be had.
Yes. The second, so in our world, there's in the main world of accounting, there's three. In our world, there's two. And the second type of cash flow is financing cash flow. So financing cash flow is money in and money out due to financing activities like loans from the
Mhm.
bank, or so gaining a loan from financing or paying off a loan from financing, as well as any shareholder contributions or distributions.
Mhm.
So financing cash flow is the change in cash from anything other than operating, right?
So like, as I've been beating this drum now for years, and how you're clearly articulating, your model clearly shows this, is back to simple terms. We did all these things based on all the 11 KPI, or the 11 KPIs that we're talking about. The 12th one is the indicator of how well that all worked and what the cash
Yeah.
is. Then we say from an ownership. So now we have only a couple decisions to make. One, and so of that, the distributions for owners, it would be taxes.
Hmm.
So you'd have taxes that you'd have to pay that month, whether it's estimated or not. You're still going to have to pay taxes.
Hmm.
Then you have owner's distributions.
Hmm.
Let me take it in a different order. Taxes, reinvestment.
Hmm.
So if you're going to reinvest it, you would say, let's say it was 100 grand, and then you go down, you say, okay, well, now I have, 30 grand in taxes. Then I'm going to reinvest 20 grand. Now I got 50 grand left over.
Hmm.
I mean, so you're just going through this. I call it just the plinko. It's like dung, 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 dung. And like, it's
Right.
like, we're trying to get to like, but after the operating line, those are the ownership. Cause like, that's their choice. How you handling taxes? How much do you want to reinvest? How much you taking out?
Yeah.
That's
Yeah.
the decision tree that everybody, I think, that you and I work with, that's why they started their business. And then everything we've talked about so far is what they got instead. It's like, wait a second.
Yeah.
All of that freedom and money got sucked up into the first hour and a half of the conversation. And now I'm finally at where I want to be.
It's back to that first episode's title. So where's the money? Yes. Yes. And let me think. So, okay. So here's the deal though. right? So
And
operating,
I forgot debt too. So back to
yeah,
like
well, so you have to pay
you want to
your,
go back into just
yeah,
Ryan
let's talk
without
about
Ryan's
financing
ramble.
cash flow.
Yeah.
Yeah, because so you're have we got to put in financing cash flow, then we get to net cash flow, and then I think we choose like what to
Okay.
do with the net. So financing cash flow. So the thing about, okay, when we talk about cash flow and then cash flow margin, nuanced, right? Because we can say cash flow was $100,000 or cash flow was 5% of revenue, right? Helps us again normalize it. Like, what are we really
Yep.
talking about? Is $100,000 a lot or a little? Like, are we
Yep.
running a
Yep.
$10
Yep.
billion company, or is that a lot of money? Is that 10% of revenue? So it's important to remember that when we start measuring cash, to also put it as a percentage of revenue on the flow side of things. Before I move to financing, I just want to put this in perspective. Operating cash flow could be positive or negative. Okay. And all it means is, like, let's say we're doing cash flow for 2024. We're recording this at the almost end of 2024. So we're saying, let's say it was a negative. And at the beginning, on January 1, when we started measuring it, it was $100,000 in cash. And when we ended the year, it was $80,000 in cash. So the
Hmm.
net cash is, negative $20,000 or 20%,
And you
right?
could have had a positive net income in that period too.
Yes, it just says that your ending balance is less than what your beginning balance was, and everything in between is what happened, right? You could
Right. Right.
so it's just information, but it did end in a net negative, or sorry, not net, but a negative operating cash flow.
A use of cash, but back to like why all these other KPIs matters, because you could have had your net income could have grown over that period of time.
Your
All
assets
the
could have grown, and that's
right.
where the cash went, right? Like, that
Yep.
was an operating expense that took. It was,
Receivables
but
or
it depleted
inventory.
our cash. Yeah. And it could
Yep.
have been strategic. Like, your goal might not always be to maximize this, depending on what you're
Yep.
doing, especially if you're in growth mode, right?
Yep. Yep.
Or yeah, like really any kind of growth mode. Okay. So that's the first good point to remember, because I want to say, back to my example of when I rank my CEOs in the group. For one thing, I don't rank net cash flow. That doesn't go towards their score. And I rank cash flow at half points. And I'm going to show you why. So the next piece is financing cash flow. So that is the change in all of our financing activities and shareholder contributions and distributions. So if our debt at the beginning of the period was 100,000 and it went to 80,000, that's a negative net financing cash flow of 20,000 because we paid down the debt.
Hmm.
And I always ask people, is that bad or good?
Depends.
Exactly. Because
Mhm.
if our goal is to pay down the debt and we needed to because the bank told us to, or whatever the case may be, then that's actually exactly what we wanted to see on this side
Yeah.
of things.
And this is where, and you probably get into this as you get into the reinvestment, but like, um, so many people are like, oh, and they just default to paying down debt, but like debt's cheaper than like, so if you can figure out how to reinvest for higher growth and that return on equity, that's how we're using these levers going like,
Strategy. Yeah.
right,
Yeah.
right.
So net cash flow is the sum of operating cash flow and financing cash flow. So in the example I just gave you, we have a negative 20 plus a negative 20. So we would have a negative 40% net cash flow. But what happened is, up in operating, we bought a bunch of assets and that decreased our cash. And what happened on financing is we paid off a bunch of debt.
Hmm.
So is that bad or good?
It just all depends.
Just depends. So when I go to rank cash flow, I only give it 50% weight because I can't say with certainty what you did was bad or good. But what we can say, and what I always reply to people is, listen, we're going to look at this over time. We're going to look at it at the beginning of the year. We're going to look at it every month of the year. And we're going to look and see, when is cash flow positive? When is cash flow negative? And why? What were we doing? Was this strategic, or did we take our eye off the ball and just like hemorrhage cash? Like, what happened there? And then we're going to notice, when is it going to be positive? Because the definition of going out of business is ongoing negative net cash flow. You cannot
Hmm.
go on and on and on. So we're going to set a forecast for, okay, 2025, 2026, we have all this cash, we're going to reinvest it, we're going to pay down all this debt, and we're going to have we're going to build up our assets. But 2027, the tide is changing. The cash flow
Well,
is
and this is
coming in,
where
right?
I I wonder if, as you're working with your Excel developers, so I understand why you would rate cash flow in half points because you're not sure what their goals are. But like
Right.
with my clients, if we said, "Hey, I need $500,000 in free cash flow every year for the next 5 years," and when we get to year 5, here's exactly what I want my income statement, balance sheet, and cash flow to look
Yep.
like. So then we technically that could be the only score.
Exactly.
That's like,
Yeah.
okay, like it's like 100 as a weight, it's like 100% of the weight. It's like you're
Yes.
literally doing the opposite of what you want to be doing.
So here's the thing though, and this is because I'm doing, group people, I'm like trying to take everybody and say like,
Yeah, yeah.
yes or no, is this good or bad? And I can't say it objectively.
I
But
know.
yes,
I
no,
wasn't
no, I know,
projecting that
but
onto your
Ryan,
situation.
we also have to look at like the difference. And this is why it's hard to look at net, right? Because net, you could bring on so much debt, right? So if the change in financing cash flow went from 100 to $300,000 and we brought on $200,000 worth of debt, we could offset the operating profit losses and artificially it would look like we
Yeah.
made
Yeah.
money,
Yeah. Yeah. No, I'm tracking it. Yep.
right?
Yep.
So financing cash flow can offset operating cash
Yep.
flow
Yep. Yep. Yep.
and
Yep.
totally take us off mark. Like if we're not looking at all three levels of cash flow.
Yep.
So we
Well,
want to
and this
focus
and
on
that's
operating
what
cash flow.
that right there is, therein lies the conundrum that these PE firms have got themselves in,
It's exactly what I was
because
thinking,
they
yeah.
saddle it with debt. And so much of PE debt is variable, Tracy. Oh, I know. Look at your face. And
Yeah.
so now what's so crazy is you and I have run companies, and we know the level of reality of, like, back to why people on this call or listening in, it's like, how real is this prediction?
Yes.
The
Right.
financiers don't know operations, so they're not sure. They're like, so then they like do all this. They're starting from everything where we are, and then just hoping that it all works out. And then they saddle it with debt and just hope it all works. And you just go, well, how much is left over after this is all said and done?
I was working with somebody who's a brilliant CFO, and this was a while ago, and he was building a model for his company, a growth prediction model. And I was like, oh, he's gonna have the coolest algorithm for like predicting growth, and I can't wait to click into all these formulas on his Excel spreadsheet. And it was a pretty complicated business, and I won't say what it is because if these people are listening, they'll know exactly who it is. But the model just had growth rate at 10%. And I was like,
Oh my God.
wait, this is what we're all hanging our hat on, is just you just increased every year by 10%. Like, how? How are we gonna do it? Like how would, first of all, it increase at 10%? And then these expenses aren't created equal. Like it was a really high maintenance, really expensive to run business. I was like, I don't think it's gonna scale like you think it's gonna scale. It's one thing to make a financial model and multiply everything by 10%. It's a whole other thing to actually roll up your sleeves and be an owner operator and make it
What's the
happen.
reality of that future happening, which is where the risk of the cash flow comes. So before we get into the forecasting and some of this stuff, and then people are still listening, God bless you. This is going to be so, my clients are going to absolutely freaking love this. And anybody listening, and I mean, like, this is how we empower ourselves for decision making. But so you've got the operating cash flow from financing activities.
Mhm. And then net, which is just the sum of the two.
Yep.
And
And that right there, but like, that is the sum of the two. But I think, with the owner's distributions, that's taking back to why I think the financing activities is so important, because you have in the financing activities, you've got the debt,
yes, and the owners,
tax,
yes,
debt,
and
owner's tax.
distributions,
Yes.
which are
But
taxes. Yeah.
both though, right? So let's say you had that, let's say you had the 100 grand in operating cash flow, and then you have 20 grand in debt, then you have 20 grand in taxes. Because I mean, even though it says distributions, but you're taking a distributions for taxes. So like,
Yeah. Yes.
that's why I'm saying that they're separate, even though like a
Okay.
lot of times they'll be in one line, but you need to do it, and it's not yours. So like, unless you work
Yes.
with Roger Roundy and you're mitigating your taxes with strategic associates, but like,
Do that.
you
Yeah.
do that. But you have debt,
Yes.
then you have the taxes, estimated or prepaid or whatever it is. And
Mhm.
then you have your
Your.
distributions.
Mhm.
So let's say it's 20, 30, and then you have 50 grand left over, and then it's zero.
Yes.
So
Right.
then like that's how, but like at the end of this is what's so fascinating to me, Tracy. We need to understand everything about the operations and how they tie into everything we just talked about to be able to guess that we're going to have that 50K a month
Yes.
now and into the
Yes.
future. And then the goal is with the forecasting is predict the future.
Yep.
And like all the way down through all the stuff. I mean, we can
Yep.
get into that, but like any thoughts, any more on the KPIs before we move into the kind of the bigger picture?
Yeah, no, I mean, I think it's just, if anyone's just like, how is that ever going to be possible? There's a whole other piece of this that I teach, which is talking about the stage of business that you're in. And, realistically, we have to think about like what a mess it makes on our balance sheet when we're in a high growth phase.
Mm-hmm.
So the thing about doing all of this stuff is that we might have to break some eggs to make the omelet, right? Like if what we want to achieve requires reinvestment, it's not going to look all beautiful and safe and within these like ranges, because in the book we give you like the ideal ranges for what all these things quote unquote should be. I just want to give everyone kind of like that like no judgment zone of like, yeah, you might make a mess out of your balance sheet for a period of time because you're gonna risk some things. You're
Well,
gonna
and
go do
and
some
you'd even
things.
do you even think that mess is the right adjective? Because the way I would put it is like back to it depends on your goals and back to like
Exactly.
the top level of the independence by design owners framework. It is we all have a trade-off over our time, our cash flow, and our equity. So when I'm hearing you say mess, and I understand like mess meaning if our goal is free cash flow,
Mhm.
but we're in a high growth, we might not have it. But like
Yeah.
if someone says, I would rather back to the decision tree of reinvest of funding, it's like you can either fund it from your own operating cash. So you chose to take less distributions
Mhm.
to reinvest that 50K,
Yep.
or you tap your line of credit or a loan, or you go raise money from a minority partner or seniority partner. And like, but there's like when I do my workshops and I get to that point of the cash, it's like if this is zero, I'm not Jay Powell. Like I can't just print money out of thin air. Like
Right.
what we have to do is we have to go and say, stop your distributions,
Yep.
or tap your line of credit,
Yep.
or take out a loan,
Yep.
or go raise minority equity, mez
Yep.
financing, or I'm sorry,
Or
mez financing, then minority equity, then seniority. But like, you
yep.
can't just say I want it all, and like it's like Charlie
Yeah.
in the Chocolate Factory get like kid. It's like I want it all now, and I want my money. So, but it's like if you can do all that reinvestment and grow fast, you would have a higher equity valuation, but you would have less cash.
Yes.
So like it's
Yes.
this just this trade-off based on their goals. And like that's why the goals of the owner have to be in the theory of constraints. It's like whatever your freaking goals are has to be there and your target has to be there for us to see the constraints based on your goals. And then you get context for like I think there is no right or wrong answer. It just depends on what you want.
Yeah, and I think what people get caught up on for me is because I might tell them like here's your industry benchmark or here are the recommended ranges, right? And they're like wanting to follow the rules, quote unquote. And I think we have to give ourselves permission
What
to.
entrepreneurs are going through your program?
Right. I know. It's like, no, no, no. And
Following
it's
rules?
also,
My
well, or they
bad.
don't want to be wrong. They don't want it to be
Yeah,
wrong,
I've
right?
tried.
Like they feel
They want to be
judgment.
measured against them. Yeah,
Yes, they want to
yeah,
be
yeah.
winning is really what they want to do,
Yeah,
right? And so,
that's it. There you go.
yeah,
I
yeah.
better word.
Yeah. So like, well, wait, am I not winning if these numbers aren't dead on these
Yeah.
like targets or forecasts or whatever? And the answer is no, it's both, right? Like you might have to change, you might have to be well off the mark for a while in order to get them on the mark. And
Yep.
that's okay. So
Yep.
that's kind of the message. It's like it might be not perfect. Like the score might not be in your favor for a while before it is. And that's kind of
Yeah,
the way
depending
this
on your
looks.
goals.
Yeah.
So in the spirit of time and making sure people's energy is not depleted here, what I was thinking is we could spend like 5 or 10 on the forecast and then wrap it up.
Yeah.
What do you think?
Yeah, let's do it.
So I'll talk about the concept that I teach. And when I say just teach, it's more just what I needed to run my business. And then what I then therefore extrapolated into other people is, okay, so we've got the financial package. I'll explain what I want. And then maybe you can kind of tie this all together, like how the CFO or the 60-minute CFO model does this in your training. And we can kind of let people continue to explore. But like, So we got the historicals that end up plugging in. You're plugging in all this stuff to get to, let's say we've done all this work and we've got the 14 KPIs. We're doing monthly meetings. It's like, where the hell are we going? So
Yes.
like when I talk about how we look at the forecast, and I'm excited to hear how you want to plug in how the model works on this, is like, okay, so we're sitting here December 2024 next year. What are we doing? So then I always, my philosophy is you start with revenue and you go line by line by line with the GL codes. Say, okay, 50-50 chance of hitting that for every revenue code every month for next year in the actual month. So 50-50 every single month, every single revenue line. Start with sales, then you go to your cost of goods and you say, okay, and oddly enough, that these three parts of the income statement tie right into the three functional areas of EOS. So you go sales and marketing, where are we going to go month by month by month, line by line by line? You go to your service ops overhead or whatever, or service ops or your production. You say, okay, we need to hit these margins. How are we going to hit those margins in every line by line by line, month by month by month? So the costs match the revenue. And then you go to your CFO finance director and say SG&A overhead, line by line by line, month by month by month. And we're building out that income statement with our ideas with a 50-50 chance of hitting it based on the strategies and all the different ways that we're going to get that revenue, service that revenue, and then make sure the whole thing continues. Then all of the stuff flows from there. That's like the ideas that everybody has. If we do that, the work that we just talked about, and then roll that into a detailed income statement, the 60-minute CFO model will build out the balance sheet, connect it together, forecast in the future, forecast out the cash flow statement, like all that shit that we just talked about. As long as they know how to read it and they put their ideas in the income statement. So we need to do 2025 detailed. And then what you've been working on is, let's take 2026 through 2029 or 2030 in a higher level assumption of how certain things might move, but we're not getting as detailed. And like, we're just trying to predict the future, but that's why I like the 50-50 chance of hitting it. But we can't do last year divided by 12, add 4%, because if we want to know in June, do I have that 50K of free cash flow? I have to do this.
Yes. Yeah, I could not have said it better myself as to what you just described. And the cool thing is that you are informed by the past, right? And because you've been doing this work on a monthly basis and you can look at year over year, like, I always recommend looking at the last trailing 12 months worth of data and then start rolling it up to years so you can see.
TTM. I love it.
Yep. So you're looking at it, what it was, what happened, and you can remember what went into those things, and you are just better informed for the future. People get all wrapped up about the word forecasting and budgeting. It's just guessing. You're just guessing.
I think it's therapeutic, Tracy. I used to, like, when I was so intimidated with it 10 years ago, but it's like, I'm an idea guy and I want to know if my idea works. And if I have an idea and I make no money next year, I don't want to do that idea.
Right.
Right?
I feel like for me, it's a landing place. Like, I'm just like, well, you know me, we've talked about this. Like, I keep all my ideas in an opportunity matrix and I rate them all based on like fulfillment and revenue and what it reach and like all these metrics. Right. And so then what I do when it's time for forecasting is I pick off the opportunity matrix what I'm going to plug in. And I run the forecast and I'm like, okay, well, in order to do that, I would need to invest this and I would need to do that. And this would net me this. And do I feel, and then I kind of get like the energetic side of it. Like, does this light me up? Yeah. Like, do I want to do this or would I rather just like sit on my couch and do nothing? Yeah, no, I think I'm going to do this. Right. So that's like, it is therapeutic, right? It's like aligning with your future self. I get really,
and Tracy, I don't know how much you've dove in or we've talked about Ken's value opportunity profile, the 8 functional areas, but if someone then goes and fills out like their assessment on the 8 functional areas of a business and they say, okay, well, next year, if we do this, we're going to have 800 grand to reinvest. Where the hell are you going to put that? And how are you going to, because Ken's VOP is essentially the theory of constraints for cash flow. So it's like, okay, well, as you look at all the financials is one aspect of the VOP, but then there's sales, marketing, and then operations, people, legal, and can't remember the other one is. Anyways, those 8 functions have to be in balance, and the theory is in balance with those functional areas will free up cash flow. So he's identified in those 8 functional areas how they tie to weighted average cost of capital and free cash flow. So the goal is then saying, okay, well, here is how we rate on ourselves in each of these 8 areas. let's work on the lowest, weakest point, the bottleneck first.
Mhm.
But then in each of those areas, what are our ideas? What are ideas for marketing? What are ideas for
Right.
sales? What are ideas for ops? So instead of just, should we do the ERP implementation or the, HRIS
Right.
system? I
Right.
don't know. Well, the EOS rock, let's put it as this. So it's taking
Yeah.
this objectivity on the projects,
Yeah.
roll those into the budget so that way the projects have a dollar amount to them.
Mhm. Mhm.
The
Mhm.
execution should be going on through EOS. So you're literally executing this stuff with EOS. But then in those meetings, you're looking at budget to actual with the numbers.
Yeah. Yes. And then until like you're either it's either panning out or it's not. Because that's the other piece. It's like you get in the car and you're ready to go, and if we aren't tracking where we're going and like how much fuel it's costing us or whatever, we might choose to actually not go there anymore, right? Like because
Right.
we only just guessed 6,
Yep.
12, 18, 2 years ago, like on the mission that we're on. And when I teach this stuff, like there's people who believe strongly that failing to plan is planning to fail. And then there's other people who are like, why even bother? It's all going to change anyways. I don't know. It's just a waste of my time. I don't really have time. I don't really know how to do it. So why would I'll just react. I've gotten this far reacting. I'll get that, I'll continue. And it's so much easier. Like Mike Tyson says, everyone has a plan until they get punched in the face, right? You're going to get punched in the face. But if you've already thought about what we might do when you get punched in the face, it's so much easier to react. Like you're going to have to
Did you
react.
listen? Do you know that that's what I titled one of those shows?
No.
No shit.
What'd you
Like I
call it?
did. I
Everyone
said
has a plan?
no, you're gonna get punched in the face, so you might as well plan.
That's
It's like that's literally what the whole conversation was.
Mike
So,
Tyson.
amen.
I love it because I just think that we all know we've all been punched in the face.
Well,
So,
and it's like, back to your point, like, and this is literally how I operate my life. Is like, I'm an idea guy. I have goals. It's like, if I want this much free cash flow and this much independence in 5 years, I'm gonna just course correct to get me there.
you're
But like,
gonna get there.
yeah, and like the operations might juke and jive your strategies, your industries, but like the peg is the roadmap, and then we're just taking budget to actual, and like, because like the cash flow is the oxygen. We need it.
Yes.
And so like we're
listen,
just having to figure out how to navigate it.
the 14 things that I just listed off, if at a minimum you do those, you will have oxygen. Like
Yeah.
literally I exist to reduce the business failure rate, and 80%, well, first of all, 70% of businesses fail in the first 10 years. And 80% of those failures are due to financial mismanagement and running out of cash. And
Yep.
everything that we just talked about is the antidote to that. So even if you have like you want to shoot for the moon, you will land among the stars if you at least do these 14 things. Like
Well,
you'll
right,
be in
and
business in 10 years.
yeah, and just to a couple like last comments as we wrap up is like Jack Stack. He said on my podcast years ago that, and I don't, this is all anecdotal from him, so
Mhm.
whatever, don't hold me to it. But like he said, over 50% of the Inc. 5000 can't pay 2 payrolls. And it's like, well, who
Well,
gives a
it's
shit
their
then?
because
Yeah,
it's their growth rate, which, like I said, made like for lack of a better
yeah,
word,
it's
mess.
the opposite of
Yeah, like you're
yeah.
not going to be
So
winning.
it's like,
Yeah.
and then Ami Kassir, who was on the podcast a couple times, he goes, I don't care about the Inc. 5000 award. I want to have the Sleep 5000. Like if you have an Aura ring and you're sleeping 8 hours and you wake up and you have no stress, like that's actually the name of the game. All of this stuff is the game of life as an entrepreneur, and I just think it's about measuring how we're getting to where we want to go.
Yeah.
And it's just I don't know. I don't even, I've lost my last train of thought on that, but like I have so much fun working with you. I'm so excited about the stuff that you're doing with my clients. 60-minute CFO training program. You got one coming up in January. I don't know when this episode goes out, but your model is enhancing.
Oh yeah. It's going to
Any
be
thoughts
very good.
as a final wrap up here?
Yeah, no, I mean it's likewise. I just think that whatever your goal is, it's such a good compliment to take the time to become financially fluent. Because, like I, in my little mini series podcast, I just say I end each one with no one's going to care about your business as much as you.
Mhm.
So whether this feels like a spoonful of medicine or it's a little bit music to your ears and something that you're excited to dive into, I would recommend just everyone
Yeah.
taking a little bit of medicine, right? And it gets easier and easier over time, and it eventually will get you to your goals.
We'll put your link to that Spotify mini series to your training. But also as a comment, I because I don't want to leave it necessarily on that there's a lot of mind garbage with my clients for sure, is that no one will care about your business as much as you. Agreed. However, if the goal is to get out of the operations, we can't let that thought process
Oh,
get us trapped. And here's what I believe is what we just talked about. If we understand this, we understand some of the framework, other parts of the framework that I've been talking about, placing the right cultural fit as the CEO in there, it's still, if you still own the company, and this is where I think a lot of the mismatch of people when they sell, they have a completely value mismatch with the PE firm who actually has the final decisions. ESOPs are like, that's a whole different conversation. There's still control over there. But like, if you're my CEO and I'm the ultimate decision maker and I understand how all of this stuff works, I can fire you.
yes.
And I know when and why and where, but like, it's like, I'm looking at the mechanics. It's almost back to the car, Tracy. It's like,
Yeah.
the car's working, but you're my co-pilot and I don't like you.
Mhm. Mhm.
So like, get out of the car.
Well, and you
Like,
know enough. Like I think what you and I agree on is it's like let's not outsource the vision and the dashboard like understanding. Like it's you could probably hire someone to come in and do the dashboard creation and manage it really well, but like are they going to still care about it as much as you? Probably not, but they could do a really good job.
do you like,
Yeah.
well, yeah, it's the bullshit factor. It's like, how did they fill out the balance sheet? How
Mhm.
are they doing these numbers? And if you don't know how they filled it out, you're completely outsourcing the trust
Yes.
that
Yes.
everything is exactly the way it should be. And it's kind of back to like, you can't outsource. No one cares about your health as much as you. The
No.
doctors want to submit
Yeah.
an insurance code to make a bunch of money off you. No one gives a shit. And like,
But
it's
should you
kind
not go to the doctor? Of course not. Like, should you not find a
exactly.
trusted medical provider for your
Yeah.
health? Of course you should. So,
Yep.
yeah,
Yep.
that's kind of the just like the ownership of this piece of your business, right? Like
Yep.
own this piece of it as well, and then
Yep.
yes, you can definitely put all your trusted advisors in, and you'll reach your goals.
Tracy, thank you so much. This is so much fun.
Likewise, I love it.
Thanks for tuning in and spending the time with me, Tracy. I hope you enjoyed that conversation. A couple takeaways I want to leave you with. One is that the financials empower us to make better decisions, reduce our anxiety, and actually do more of what we want, whatever it is that you want. And I think the big thing here is you got to figure out what you want out of time, cash flow, and wealth. And then the financials can help you mold the operations around that. And there is no right or wrong answer as far as, do you reinvest in the company, take more out? Do you slow down your growth? Do you increase your growth? All of that depends on your goals. But understanding the financials and then how the operations tied to the financials empowers you to take control over your business and your life and your decision making instead of having to outsource all that to other people, where then you become more surprised on what happens because your goals are reliant on other people. And I think it's our duty, just like our health, is that we have to understand the numbers, because if you want to delegate and then actually step out of the operations to some extent, understanding how the operations tie to these numbers and these numbers are a result of what's going on, it allows you to then do what Joel Trammell and I were talking about in the podcast a couple weeks ago, to be able to ask questions so you can better determine if you have the right people in the right spots. And it's your duty to understand how everything connects together. And I hope this episode helped you. If you wanted to check out Tracy's training program, I highly recommend doing so. The 60-minute CFO link is in the show notes below. She does a fantastic job. A bunch of my clients have gone through it. You end up getting the 3-statement model that we talk a lot about. And I just want to give Tracy a big thank you on my behalf and my clients' behalf, because she's been supporting my clients, making sure that their controllers, CFOs, directors of finance can actually learn how this stuff works, plug in the information. And I think it's really an interesting opportunity, because with the financial model that Tracy's built, it takes less, or actually, it provides us less. Let me try to think how to say this. It allows us to do more with less from a controller or director of finance who might not be the savant CFO that I always talk about with Pat, because we're plugging the operational data and then the financial file is building out all the math equations and stuff. So it leans more on your ability to do the planning and thinking and then data entry, instead of having to also be an Excel ninja and a mathematician and a CFO. So I really, really appreciate Tracy, and I think she's helping smaller businesses, owner operators get more empowered because of their ability to access the insights and the information that I'm talking about all the time. So go check out our training. Thank you so much, everybody, for tuning in, and stay tuned for next week, where I got my buddy Jimmy Fritz talking about how he's implemented a lot of the ownership framework and the financials into his operations and what that's done for him as an owner, and how he integrates the financials, his ownership objectives with his two companies, integrates a lot of that stuff into EOS, and all the hard work he's put into this journey over the last 8 years. So stay tuned. I know you're going to enjoy that. Thanks, everybody. And I hope you enjoy it. And I will see you next week.